We're seeing expected March rate cut bets come up just a touch.
I'm pleased you brought up the difference between the BOJ and the Federal Reserve. So now we're talking about rate cuts at the Federal Reserve, we're talking about hikes at the BOJ, after we talked about hikes at the Federal Reserve and the BOJ doing nothing.
They like to dance to their own music.
Isn't that amazing?
Well, yeah, and here's the key. Is the Fed giving them a window to hike rates, that essentially they won't blow out their currency to such a degree in terms of strength that could really offset some of the gains? Honestly, a lot of people are expecting this. The question is just how they're going to do it in a less disruptive way. Remember 2 years ago, we were saying this was going to be Armageddon for markets. I know I'm using that word again. But,
yeah, no, sure.
And people were saying it's going to really be disruptive. It wasn't. It hasn't been. And now people are expecting maybe even in April, abandonment of
I think I called it Operation Ostrich, didn't I?
I love that
BOJ,
phrase, yes.
head in the sand,
Yeah.
head in the sand, and it's worked out. So far.
Maybe Operation Ostrich is the way to go.
So far. A week away from a Federal Reserve decision, just a couple of days away, in fact 24 hours away from an ECB decision. Here's the FX market in the euro specifically against the dollar. The euro positive by a third of 1%, 108.93. Under surveillance this morning, former President Donald Trump taking another step towards a rematch with President Joe Biden. Trump easily defeating former UN Ambassador Nikki Haley in New Hampshire, posting back-to-back wins after cruising to victory in Iowa. Haley vowing to remain in the race, but options for her campaign and anti-Trump Republicans are running out. AMH, you've had a few hours to chew over the numbers. What jumps out to you?
Well, what jumps out to me is that it wasn't as bad for Haley as the polls were expecting, but at the same time, he is really consolidating his lead. It's back-to-back wins, as you mentioned, Iowa and New Hampshire, and it looks like it's going to be the general election rematch that most of Americans in polls don't want, and that's Trump versus Biden.
So there are two things. Number one, what's the point of Nikki Haley staying in? And a lot of people are thinking about this seriously in terms of, is this just basically a play that if Trump's legal issues become too onerous, that she can somehow take the helm? The other question is dissent among both parties. What happens if it is an unpopular election? And then from an investor standpoint, how do you arrange around this? We just heard from Chris Morangi. People aren't expecting to do big deals because how do you do a deal that's not going to close before a really uncertain election?
And you might get an easier regulator in the next 12 months as well.
Correct.
I think we are learning something, though, AMH. I'd love your view on this. Where independents are leaning, where they aren't leaning, and what this could mean for the former president on the national stage in the next 10 months.
Independents were certainly leaning towards Nikki Haley. So this goes to show that, does Trump have a problem when it comes to the general election? I was also caught by the Biden campaign statement last night. This is what they said. Donald Trump is headed straight into a general election matchup where he'll face the only person to have ever beaten him at the ballot box, Joe Biden. There's only two people who have ever faced off Donald Trump in a general election, and that was Clinton and Biden. So that's their pitch.
Yeah, I mean, facts aren't popular in politics these days, are they? That's like kind of it at the moment. Let's turn to China, get some facts out of China for you. Authorities over there making another attempt to boost the economy. The country's central bank announcing a cut to the reserve requirement ratio by 50 basis points. The move becomes official next month in an attempt to free up lending and cash to the economy. China's government also mulling a $278 billion rescue package to backstop stock markets as growth worries continue. This is becoming an issue. We're talking about the plunge protection team for the equity market, the central bank coming out and saying we'll ease the supply of credit into next month as well. And you just get the feeling, Lisa, this is the beginning of it. It's not the end.
I don't really understand what the goal is, though, because right now, are they trying to ignite lending? The problem is demand for loans. It's not necessarily the actual rate, because rates are incredibly low. Are they trying to encourage international investors to come in? They also overnight recommended or basically banned certain transactions in onshore funds that had offshore kinds of accounts. At what point does this have the opposite effect of attracting international flows if policy is just that uncertain and, frankly, that controlling and not sort of according to at least a U.S. version of a capitalistic economy?
Alicia Levine put it perfectly earlier this week. She said capital goes to where it's treated best, and right now that's in Netflix stock. That stock looks like this in a pre-market, surging. Trading in pre-market trading after reporting its best quarter of growth since the pandemic. Over 13 million customers signed up in the last quarter of 2023 thanks to a cheaper ad-supported version and a crackdown on password sharing. The company's guidance warning more price hikes are on the way, saying, quote, as we invest in and improve Netflix, we'll occasionally ask our members to pay a little extra to reflect those improvements. We're up by almost 11%, Bramo.
Honestly, it's basically the new tax of capitalism. I will just say this. When you sign up for something and then it's automatically paid, you don't think about it. So they could jack up the price $2 a month and you don't think about it. You just pay. I wonder how much that's part of this whole dynamic. We're going to ask our clients, our customers to pay a little bit more. Yeah, they're going to kick up the price, and everybody's just automatically going to pay that, and that seems to be the tax.
Make it sound like a charity, you know.
Exactly.
You know, contribute a little bit more. You're enjoying the product so much.
But it's not bad, at least if they have good content. As to our guest yesterday, content really is king when it comes to Netflix. They have a huge library compared to everyone else, and you look at that churn rate, people keep on to Netflix, hold on to that, versus all the others.
I guess that's really the key question, which is when do they drop the others, given the fact that at some point it's going to become onerous. How much is the bundle now if you put it together?
My bundle is more than the cable bundle.
Of course it is.
Let's put it that way. I think I'm going to have a spring clean, go through all the apps a little bit later.
What are you going to get rid of?
You want me to say this on air?
Yeah.
Like Apple, if we still got it, I'm not sure if we have, that can go.
Okay.
That can go.
Good to know.
A Paramount, I know I've still got that. Maybe that can go as well.
All right.
Hulu gives me the Disney Plus ESPN bundle, so it's hard to sort of like separate all of that. But Hulu's got so expensive.
Yeah.
It's got ridiculously expensive. I'm paying an absolute fortune for that now. Plus you pay for the broadband connection as well. You're looking at 200 plus, whereas cable all in with broadband costs what, 120, 150?
Correct.
Before, yeah, which is what you're still doing.
No, I'm doing it all.
I can always get the sense when you're looking down at what I'm doing. Like, you know,
no, I'm actually not. I probably pay stupid amounts, and I need to go through too.
Let's turn to tech earnings. Already kicking off. Tesla and IBM after the bout today. Tesla looking to deliver after losing pace among the magnificent seven in the rush to AI. Mandeep Singh, senior technology analyst for Bloomberg Intelligence, joins us now. Mandeep, it's been a struggle for the EVs. We heard the news from Hertz in the last week. We saw what we heard from Ford just a few days ago as well. Mandeep, is it a struggle for Tesla as well, or are they different?
Well, so it's all about expectations. I mean, what Netflix did last night was a case of, low expectations and then kind of pulling the levers. In the case of Tesla, I would argue, expectations have come down, but clearly a lot is pinned on hope around AI and what they could do around robotaxis. And so far, they haven't given any concrete data points around, how they plan to monetize that business, except for the FSD charge of around $12,000 that you have to pay. And that's also a very low install base of consumers, the Tesla car users who have opted into that. So that's where, the top line growth continues to be much higher than the other OEMs, but that really the valuation multiple depends on the software and the robotaxi side of the business.
Mandeep, I got to say, Elon Musk overnight came out with a tweet basically saying that Tesla is an AI company with a car operation pinned on. How much is that going to be borne out in earnings? Essentially, if they disappoint with the car deliveries, they could still do well if they explain exactly how they are an artificial intelligence company and not one that just simply manufactures cars.
Yeah, and more so now with this wave of AI, the focus on large language models and how much data you need to train these models, it begs the question, Tesla already has about 5 million vehicles. They're about a $2 million run rate of new vehicles every year. So they could keep aggregating those miles, which you need to train the models. And we have the technology now with, these foundational models. So Tesla, in theory, should be leading the pack when it comes to autonomous driving, and they're the most committed. And they just need to articulate that in terms of how they are going to monetize it. And I think people will buy into that story.
The exact quote is, Tesla is an AI robotics company that appears to many to be a car company. Mandeep, BYD looming large over Elon Musk's head. And overnight, we heard from the executive from BYD, the Chinese EV car manufacturer, just basically amping up this competition. How much are the Chinese EV manufacturers eating Tesla's lunch in a material way?
Well, I look at it this way. Last year, Tesla's chargers were used by a lot of the OEMs who wanted to roll out EVs. And that, to me, is a validation that Tesla has the footprint now when it comes to being that early company around EVs and having the infrastructure. And let's say if other OEMs start licensing their software, the autonomous driving software, that would be another big validation. In the case of BYD, it's geographically limited, and I do think they don't have that infrastructure when it comes to charging stations and other kind of things that you need, for that mass adoption.
When you look at autonomous driving, Mark Gurman of Bloomberg is talking about Apple now. They wanted this truly driverless car. It seems that they're shrugging off those ambitions and now trying to bring an EV to market. What's going on there?
Well, so clearly, I think you are seeing different approaches from different OEMs. But in the case of Tesla, they have the lead, even though you could argue, level 5 autonomous driving is hard. And nobody thinks Tesla's current FSD software is level 5. They're more level 2 and 3. And that's where every OEM is right now struggling to come up with a strategy, and they haven't figured out what the best combination of sensors is, whether you need a LiDAR or you can just build a camera-based vision. And I think things will get pushed out when it comes to level 5 driving.
Mandeep, appreciate the update, sir. Mandeep Singh there of Bloomberg Intelligence on the earnings still to come. We'll hear from Tesla a little bit later. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara. Morning, Yahara.
Hi, John. Hamas officials have told international mediators they're open to releasing hostages in exchange for a month-long pause in fighting. Mediators are pushing for a phased approach that would start with civilians and end with soldiers in return for a break in hostilities, the release of Palestinian prisoners, and more aid to Gaza. SAP will restructure its workforce to increase focus on artificial intelligence, affecting about 8,000 jobs.
We are investing in AI, over $1 billion for the next 2 years, while, of course, we're also applying AI internally. We actually expect that at the end of the year, we actually end up with the same headcount as we left 2023. And for the years to come, there will be investments, there will be headcount growth, but of course, under proportional to our top-line growth.
The software company's shares surged on the announcement. Actor Ryan Gosling has pushed back on Barbie's mixed Oscar nominations. He's up for Best Supporting Actor, while co-star Margot Robbie and director Greta Gerwig were left out. Gosling writing, quote, "To say that I'm disappointed that they are not nominated in their respective categories would be an understatement." And that's your Bloomberg Brief. John?
Yahara, thank you. I'm not saying anything. Please, the floor is yours.
All right, I will just say this about Barbie. I know it's supposed to be about female empowerment, but the problem is that the men are the best characters. And I feel terrible saying this, but they're funny and they sort of like create the plot. You're shaking your head, but I think that there is this sort of underpinning of, it kind of is counterintuitive. And then, of course, if they get snubbed, people are making all sorts of...
I'm looking at Ryan Gosling's statement right now. There is no Ken without Barbie. How does Barbie get snubbed and Ken gets the award?
Is this why you're wearing pink today?
Is it? I'm actually not, but I'm so happy I did. Because I think it's, the subconscious.
Someone at the Oscars has got a dark humor, haven't they? I mean, come on, it's like down with the patriarchy, and then they give a nod to Ken and snub Barbie.
But what actually emerged from that movie? What was the swag? It was, I am Knuff. That was really what it was. It wasn't, Barbie swag. I mean, to some degree.
And let's be clear, there were some other Oscar nominations in the movie as well. Right?
America Ferrera.
Right.
Fantastic performance.
Yeah,
I think she's also disappointed because the director who went out had this huge campaign. They made so much money. It was a true blockbuster hit. And Barbie herself got snubbed. The whole point of the movie was, like you said, down with the patriarchy, yet Ken, at the end of the day, made it out on top.
I'm sorry, awards aren't charities.
I think there's no upside for me to say anything. Up next on the program, I'm going to sit this one out. The ECB and the Fed on deck.
I see a slope downward, but certainly not a slope which is at target.
That conversation's coming up next. You're watching Bloomberg Surveillance.
On the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite. You later got asked to be the head of USAID.
I got that job when I was 36 years old.
36 years old, you're running USAID. How many employees does it have?
We had 11,000.
And did you feel qualified to run something that big?
I did until, the work started.
The best thing that's happened this week. Bramo versus AMH on Barbie.
Let's move on.
What'd you say? It's not a charity or something like that?
I'm just, look, I have an unpopular opinion. I'm just going to lean into that. And
Might be
just leave it
popular.
there.
You never know.
All right, let's move on.
Maybe Anne-Marie's view is unpopular this morning.
Enough.
You're enough. Okay. Under surveillance this morning, the ECB and the Fed on deck.
When I look at a year ago in Davos, and when I compare that with where we are today, I see a slope downward, but certainly not a slope which is at target. I would have said a year ago that we are determined. We want to get it to 2%. I would say to you now that we are confident that we will get it to that target 2% medium term.
Investors betting on global central banks to cut rates with the ECB decision due tomorrow, the Federal Reserve decision a week from today. And Bramo, I'm not saying it's going to happen in March or anytime soon, but that's the direction of travel based on communication like that.
The key difference for me is how far are they going to cut, given that they got inflation wrong? And I was really interested in what Catherine Nice, a former Bank of England economist, writing in the FT, put simply, it's a case of once bitten, twice shy, and policymakers will want to make sure that the inflation genie has been put firmly back in the bottle. 2Q, second quarter, is the earliest period in the frame for cuts. Again, this is sort of the big divergence right now, not whether they're going to cut, but whether they're going to cut more aggressively or whether they're going to take some caution from the fact that they got inflation so wrong in the aftermath of the pandemic.
Let's get into it with the brilliant John Riding, Chief Economist Advisor at Breen Capital. John, good morning to you.
Morning, John.
That word confident, can we pick up on that word confident? How confident are you that we're on a glide path back to 2%, both for the Federal Reserve and the ECB?
Fairly confident, provided both central banks continue to push back against the markets. Because this is an important point, and I think Governor Waller last week laid it out reasonably well. There's a difference between cutting interest rates and easing policy. And this hasn't been communicated particularly well. Inflation's falling. As inflation falls, interest rates adjusted for inflation, real interest rates get higher. So does the Fed and the ECB want to be tightening policy by not lowering the policy rate as inflation approaches 2%? And the answer is no. The market, however, is going differently. They're putting in these aggressive cuts. And aggressive cuts historically have been to fight a recession or potential recession when inflation's been relatively under control. So I think the central banks have driven home a couple of messages. One, we're really serious about 2%. And secondly, we are not going to cut aggressively. We're going to keep policy restrictive while we lower rates. And that's sort of subtle point that the markets are missing right now.
What kind of language would you expect to hear next week then? Things like we need to calibrate policy, need to adjust rates, surgical rate cuts. What kind of language would you look for?
I think things like that. But the main thing is the Fed and Powell is not going to be in a position in the press conference to green light a rate cut in March. I think the Fed's thinking probably June at the earliest. And they're going to be pushing, there's no new interest rate forecast come out at this meeting for them to frame the discussion. The problem is Powell did a very poor job in December in opening up and talking about what's natural that we talked about rate cuts, to the point where John Williams from the New York Fed had to go on a different channel 2 days later to try and set the record straight. And it's really, he needs to do a better job laying out that when we cut rates, it's not about easing policy aggressively. It's just about preventing policy from becoming tighter. But the Fed has not laid out a strategy in a way that's clear, a strategy for running monetary policy. It was they've done a lot of discretionary policy, seat of the pants stuff, and that leaves the markets to, overlay their own interpretation. Like, they signaled 3 rate cuts, and the market took 6 in December.
Well, hold on a second. If you take a step back, it sounds like you think that the Fed and the ECB are going to have to seriously push back on all of the risk-taking that we've seen. We've seen peripheral spreads come in dramatically in the Euro region and the U.S. Priya Misra was sitting in your seat yesterday and said she's the most bullish on high-yield bonds that she's been in a long, long time. Are we going to hear direct pushback from the central bankers this week and next?
We're going to hear continued pushback, as we heard last week from Waller, as we heard last week from, in that clip you had from President Lagarde, that the markets are ahead of where the central banks are. And as for, getting points, we're not out of the woods yet in having a recession. That's something that one of the really weird things I haven't figured out in markets is you have risk assets like high-yield bonds pricing in a good economy, and you've got the interest rate markets pricing in a recession, because the Fed is going to cut rates that aggressively. We're probably going to be in recession, and then that's when spreads blow out. So there's a sort of disconnectedness between the rate markets and the spread markets right now.
There's only a disconnectedness if you think that the immaculate disinflation isn't going to continue. If you think that people have gotten ahead of themselves in this idea that inflation will naturally come down as the supply chain effects and other pandemic-related consequences evaporate. Are you pushing back on that? Do you think that the inflation rate now is substantially higher going forward than it was in 2019?
I think that back in 2019, the predominant question that the central banks are thinking is, how do we get inflation up to 2%? And now it's, how do we get it down to 2% and keep it there? But you know what? Central banks are giving us something that we rarely see in economics. You've got the Bank of Japan, which still has negative interest rates and a very easy monetary policy, versus Bank of Canada later today, versus the Fed, versus the ECB, versus the Bank of England, who have a much tighter policy. So we'll see. If it's all about supply chains, then inflation is going to come down in Japan. I suspect that's not the case. Japan's had upward pressure on inflation, and they may well continue to have upward pressure on inflation until they take action. It's an odd world where 1 or 2 words here or there, while still having negative interest rates, is considered hawkish, which was the interpretation of yesterday's BOJ meeting. Inflation ultimately is about monetary policy. It's one of those principles of economics that I fundamentally believe in, that inflation is a monetary phenomenon. That doesn't mean to say, the cost shocks and so on are unimportant, but that doesn't become inflation if the central bank pushes back on it. And look, 2021 was a disaster. 0 rates, buying $120 billion of bonds a month, while inflation was picking up. The Federal Reserve unleashed the inflation genie, and they had to do something. I've seen 4 consecutive 3/4 point rate hikes in the mid to late 2022 to push that back in. It was hard fought. We haven't had the recession yet. They've done very well getting away with it. They don't want to throw in the towel. With the stock market essentially the record, where's the cost of current interest rates? But if the Fed were to cut aggressively and then find, oh no, we made a mistake, inflation has not gone back into the bottle, hasn't stayed in the bottle, and they have to start hiking again. That's the scenario they want to avoid.
The risk cuts both ways. John, it's good to see you, as always. The brilliant John Riding of Bring Capital. 21 was a disaster. Will 2024 be a disaster? And I'm with John, most people are. December was a messy meeting from Chairman Powell. it's difficult to find the consensus that he was seemingly reflecting in that committee meeting, in that news conference, in the minutes that came out later on. Where were those comments?
He unleashed animal spirits, some people could argue. And now the question is, how do you put that back? Do they start to get more aggressive to really gut check the market's enthusiasm?
When the New York Fed president has to come out 48 hours later and correct things.
It didn't work.
And it didn't work. Something's gone wrong. Coming up in the next hour, IBM Vice Chair Gary Cohn, Kathy Jones at Charles Schwab, plus the latest from New Hampshire, from New York City. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Everyone believes that the next move by the Fed is a cut, which means people can start planning for that.
This isn't recession, cut early, cut fast, cut deep. This is move gradually and methodically.
What matters is the end point. How much are they cutting? What is the reason that they're cutting? I would argue the market's pricing in these rate cuts.
You can deliver what's priced into the curve or even less and still have yields just fairly stable.
People are just ready to throw in the towel that, it's time for cuts, let's move on. And what we've seen this month is people capitulating a little bit.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz, together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 positive by 0.4%. 4 days of gains on the S&P, the longest daily winning streak of the year so far. 3 consecutive all-time highs, and juicing things just a little bit this morning. Netflix, Bramo, knocking it out of the park.
Honestly, the rally that we've seen so far and the record highs entirely driven by big tech, Magnificent Seven. We just saw the biggest 2-week inflows into tech-related stock funds going back to August. At a certain point, they're the ones delivering. They're the ones supporting a lot of the earnings. How long will it take before everything else catches up?
The stock is up by 10%. Lisa, go through some of the headlines. Best quarter for sub-growth since the pandemic, beating projections in every single region of the world.
Yeah, the tally that Wall Street was expecting was 8.9 million. They got 13.1 million new customers for the last 3 months of 2023. Again, this is after everybody signed up during the pandemic because they were tortured with their children trying to figure out what to do with them. I'm just saying theoretically. So
of
the fact
course,
that you could get this, nothing at all. But
no.
this to me indicates the incredible growth. Are they taking over for someone else, or are they just simply capitalizing on people's need for entertainment?
Upside surprise for Netflix. Positive surprise if you're a fan of Donald Trump. Another big win, AMH, for the former president after another big win before in Iowa.
That's right. He has back-to-back wins now. Iowa, New Hampshire. I will say the margin he won wasn't as big as they expected. So in that sense, Nikki Haley did do somewhat well, given she was up against this massive lead in the polls. But it does look like he's just consolidating. And if you look ahead to South Carolina, it's 30, 40 points that he is up in some of these local polls, and that is her home state.
We keep talking about 2 questions. Why is Nikki Haley still in the race, right? What does she hope to accomplish? Is she just waiting for Donald Trump to have to bow out for some potential reason? And then the other question that I really have is where are independents going to go? And you really went to this earlier, but they seem to be migrating away from Trump a little bit more than they did in 2016.
More on that in about 10 minutes' time. Let's get you up to speed on the broader price action. Equity futures on the S&P 500 positive here by 0.4%. Bond yields lower by 2 basis points, 4.1070 on a 10-year in America. Over in Japan, the JGB market selling off just a touch. Yields higher. We're talking about rate cuts at the Fed, maybe rate hikes at the BOJ.
It's not a market. I'm sorry. Let's see what happens.
Hasn't been
when
for
it
a long,
becomes,
long time.
Right. So what happens when they actually start trading? I mean, how much of the JGB market is owned by the Central Bank of Japan, the Bank of Japan?
Something like half.
Yeah, so I mean, honestly, at a certain point, okay, but they are moving in a different direction. And does the U.S. potentially cutting rates open the door for them to do it further?
Yields up in Japan by something like 5 basis points. If you don't follow the JGB market,
it's okay.
Use the term market loosely, 5 basis points is something, let me tell you. Coming up in the next hour or so, Gary Cohn, the IBM Vice Chairman and former National Economic Council Director, joining us around a table in just a few moments. Bloomberg's Katie Lyons in New Hampshire as the former president takes another step towards the GOP nomination, and Michael Nathanson of MoffettNathanson on Netflix's blockbuster quarter. That stock is up by more than 10%. We begin with our top story. 1 week out from the first Fed decision of the year, a string of stronger than expected data leaving economists split on the timing of rate cuts. Neil Dutta of Renaissance Macro writing, quote, inflation is slowly, relatively quickly, moving back towards target. Labour markets are slowing, but they're not slowing as quickly. The net effect of that is going to continue to juice real incomes. It's not an economy firing on all cylinders, but it's an economy firing on enough cylinders. With us around the table, I'm pleased to say, Gary Cohn. Morning, Gary.
Good morning, John. Thanks for having me.
I was reflecting on our conversations we used to have many years ago when you were in front of the White House, and you used this term, the threes. Are we going back to the threes? Is that what you think we're going back to?
It feels like we're going back to the threes. You know, in the threes, for those that don't remember me standing in front of the White House talking about the threes, I was talking about 3% GDP, 3% unemployment, and 3% wage growth. That was sort of the sweet spot that we were trying to achieve at the time. And we thought that was a really good, solid place for the United States economy to be. And that was sort of the goal. That was sort of the middle of the target that we were trying to hit, you know, month after month as we were talking on those Fridays after we released job data.
What I've noticed from you is that we seem to have forgotten what normal is.
Well, we totally forgot what normal is.
You've been around for a long time. You've seen many cycles. What is normal?
So this is a campaign I'm on in many respects that we have forgot what normal is. So to go back to what normal is, we have to go back to the post-2008 financial crisis. Because since 2008, you know, the Fed has been the overwhelming dominant feature of financial markets. So prior to 2008, Fed meetings were important, but we didn't live and die off Fed meetings. In fact, I'm old enough to remember when money supply was what drove markets. Now, I'm really dating myself on money supply there. But then we get to 2008, and the Fed goes into the whole policy of zero interest rates and quantitative easing, followed by many other central banks around the world. And as the Fed goes into the zero interest rate policy and they continue to build a bigger and bigger balance sheet, they become the dominant factor in financial markets, not just in the fixed income markets, not just in the rate markets, but when you literally have zero rates of return, you're literally forcing people out into the risk spectrum. So you bring many other asset classes that have historically not been appealing to people, you bring them into play because the search for return, the search for yield, you go farther out on the risk spectrum. So we lived through the 2008 period all the way up to basically, I would say, COVID, with this zero interest rate policy, people looking for alternative assets, looking for yield, searching for it in unusual places. We come into the COVID period, and sort of the Fed stays in their zero interest rate policy because they have no idea really what's happening. I'm not sure that that's a mistake. When you don't know what's happening, don't make a change. And then all of a sudden we get into we'll call it the Biden administration, and we've gone through 5 stimulus packages in the United States, and all of a sudden we've got U.S. consumers with the best balance sheet they've had in their life, enormous amount of disposable income, the ability to finally go out and spend it after not having the ability for almost 2 years to spend anything that, like I said, you can't buy it at the grocery store, FedEx or UPS or the United States Mail Service can't deliver to you, you can't buy it. We now have the ability to go out and spend that money, and lo and behold, we end up in a highly inflationary cycle. So the Fed goes from this zero interest rate, trying to drive economic growth, trying to drive inflation, and I always remind my best friends, if you would have picked up any newspaper prior to 2000, in that 2008 to 2020 period, the Fed headline would have been, can the Fed ever create inflation again? So now we're back in this highly inflated period, and the Fed goes from quantitative easing to quantitative tightening to zero interest rate policies to 50 basis points sort of month in and month out. So we have been through this 15-plus year cycle of what I would call abnormal. On top of that, we end up with this inverted yield curve because everyone's convinced the Fed's raising rates, the Fed has to slow down the economy, we have to see job degradation, so we have to go into recession. I think the missing component there was how strong personal balance sheets were. So we don't go into recession. We still have an inverted yield curve, which I don't think is normal. So I think now, for the first time in this 15-year period, we're getting to a position where we're starting, and we're just at the very beginning of heading back towards normal and what normal would be. And so reminding people a little bit what normal looks like, it's going back to the 3-3-3. But historically, we have a positively shaped yield curve in the United States. We have a risk premium. Historically, if you look at 10-year yields, the 10-year average yield in the United States, you can either put in the Volcker Fed or you can take out the Volcker Fed. With the Volcker Fed, it's 4.6%. Without, it's 4.3%.
If you put aside all of this, right, if you take a look at the Fed and say, okay, it's on the back table, you start to look at the economy, it looks pretty good. It doesn't look like we're going into recession.
Agreed.
Why do people feel so bad?
Here's why people feel bad. Like, the inflation number and the inflation data is the most peculiar data we have in the United States. We count inflation either month over month or year over year. We don't zero baseline it anywhere. And so when we talk about inflation, we say, how much inflation do we have over last month? And if we had inflation month over month, it means what you paid last month is here, and what you're paying this month is higher. If we have inflation year over year, it's the same thing. So we've seen the compounding effect of a 3% inflation year, a 9% inflation year, a 3%, all that adds up to 20+%. So when you're a consumer today, you're a hardworking consumer today, your basket of groceries is 20+% more than you think it should be worth and what it was worth 2 years ago. So the compounding effect of inflation, because we don't have a zero baseline basket, is really what's affecting people's mentality. The second part of the equation is people are working harder. They're working more jobs to be able to buy what they want to buy. The savings from the pandemic is gone. It's not all gone. There's still a lot of it sitting in Treasury and money market. But if you look at the financial position of many Americans that went from high consumer debt going into the pandemic, Then they went from consumer debt being wiped out, they went to high savings rate because they were sort of forced in. They've actually spent all that money back. They're back to where they started. They're back at consumer debt. So they do care a lot about the inflation, and they care about their purchasing power. And we are talking about wages today exceeding inflation, but that's on a sort of spot market basis. We haven't talked about it over a 1 year or a 2 year basis.
You know, I gotta say, I wonder how messy the data is as well. And if you were still the head of the Economic Council advising the president, how would you communicate the idea that we're seeing churn, massive churn in response to technological advancements? I'm thinking about eBay laying off 9% of its staff because it needs to upgrade certain things, or SAP in Germany. You're seeing this again and again. How much is that featuring into the messiness of the data?
You know, we always have messy data. You know, we're always, like, we never really get totally clean data. You know, we could talk about all the revisions to the unemployment data. You know, it's a survey data, and then they go and revise the data from a month and 2 months ago, and sometimes the revisions are bigger than the actual data. But we of course fixate on the data on that Friday, and then a month later we say, oh, that data was completely wrong. So if you're in the world of looking for the clean, pure answer, our economic data doesn't give you really clean, pure answers on a real-time basis. If you look at the data over a cycle and over a period, it gets very clean over time. I think you've got to look at the data on a longer period of trend. That's why a lot of people, like I look at the JOLTS report. I think JOLTS is really interesting to me because it shows job openings, amount of people looking. But like what's in there, there's some really interesting numbers in there. It shows you how many people quit their job. Quits to me is like one of the important numbers. People only quit their job when they feel like there's a better job out there. So it's a pure measure of what people's psychology on the market is. When the quit rate goes up, it means I believe I can get a better job, better paying, better quality of life, and I'm not worried about quitting. When the quit rate goes down, people are saying, okay, the job market's not very good. I should be happy with the job I have. I don't love it, but I should be happy with the job I have. So there's data out there. If you put it all together, I think you can create a pretty clean picture for yourself.
Unlike this administration, Gary would actually communicate, Ramo. That would be the answer to that, but we won't get into that now. Gary Cohn is going to stick with us. Let's get you an update on some of the stories elsewhere this morning. Here's your Bloomberg Brief with Yohara Jackets.
Hi, John. Donald Trump is marching towards a November rematch with Joe Biden. After the former president comfortably won the New Hampshire primary, Trump beat his only remaining challenger in the GOP race, Nikki Haley, with the former UN ambassador refusing to back out of the race. Netflix is surging this morning after posting its biggest subscriber gain since early in the pandemic. The streaming service's decision to crack down on password sharing and introduce a cheaper ad-supported version paying off, with more than 13 million customers signing up in the last quarter. And Tesla telling suppliers it wants to start production of a new mass-market EV midway through next year. That's according to Reuters. Currently, Tesla's cheapest car starts at almost $40,000, but this reported model would start well short of that. The company will report earnings later today, with the stock down more than 15% to start the year. And that's your Bloomberg Brief. John?
Yohara, thank you. Equities right now on the S&P 500 positive by 0.4%. Up next on the program, Nikki Haley vowing to press on.
This race is far over. There are dozens of states left to go.
That's coming up next on the program. You're watching Bloomberg Surveillance live from New York City. Good morning.
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Four-day winning streak on the S&P 500 about to become 5 based on this move this morning, up by about 0.4% on the S&P. Yields coming in lower by about 2 basis points, 4.11% on a US 10-year. Under surveillance this morning, Nikki Haley vowing to press on despite her loss in New Hampshire.
This race is far from over. There are dozens of states left to go. And the next one is my sweet state of South Carolina.
Here's the latest this morning. Donald Trump defeating his only remaining rival in the GOP race. Trump's victory putting him squarely in the driver's seat. No Republican has failed to secure the nomination after winning the first 2 states. The former president now set to deliver the knockout blow, AMH, on Haley's home turf.
Yeah, the polls look really complicated for her in her home turf of South Carolina. The Wall Street Journal this morning, Jonathan, giving some advice, let's say, to Nikki Haley. They say she has an opening to take on Mr. Trump for his proposed 10% universal border tax. She can point to his failures against China, his coddling of dictators, his failure to boost defense, much while adding almost as much to the national debt as President Biden. But she also needs to grab a specific cause or two, perhaps school choice and parental rights, and make them hers. Can she do it? This is the problem. There's a huge machine now behind the former president.
Let's get to Kelly Lyons on the ground in Manchester, New Hampshire. Great to catch up, Kaylee. Let's do this all over again. Nikki Haley, does she make it to South Carolina based on what we saw last night?
Well, she says she will, Jonathan. Of course, she and her powerful surrogates like Governor Kristen Sununu here in New Hampshire had said all she needed was a strong second place. They didn't, though, define exactly what strong is, and arguably an 11-point gap between her and Trump, who won last night, isn't necessarily a strong showing. That said, she still vowed to continue on. 4 weeks from now, on February 24th, is that primary. The difficulty she's going to have is that if she couldn't perform that well in New Hampshire, even with the large base of moderate Republicans and independents here, it's very difficult to see how she could perform better in a future contest like South Carolina, where the base is significantly more conservative. The MAGA base is very strong there, and that could be potentially weaponized against her moving forward. The attacks could sharpen. So that is why many people this morning are saying essentially that the general election has now begun. Now, what we're heading for is a rematch between former President Trump and President Biden, a development that the Biden campaign is welcoming, as they believe that he could beat Trump once again, as he did in 2020, but frankly, a development that many Americans don't want. Polls show 70% would not like either man to be president a second time around, and yet it looks likely this morning that that is exactly what they're going to get.
This is now going to paint so many of the political stories, especially what's happening in Washington, D.C. If Trump is now basically almost coronated as the Republican nomination, what does this mean for a border deal? Because that would give a huge win to the sitting president, Biden, ahead of a key election.
Yeah, that's exactly right, Anne Marie. Obviously, Biden is currently actively negotiating with Senate leaders to get a border deal done. And the question is going to be whether or not that can pass in the House when Speaker Mike Johnson has a very close relationship with Donald Trump, as does the vast majority of Republican leadership. All of them have lined up to endorse the former president. And Trump has said that they should only accept a perfect border deal. Could he exert pressure to make sure it doesn't get over the finish line and be politically advantageous to his opponent, Joe Biden? One thing I will say, though, guys, as we talk about all of this very likely general election rematch between two individuals, keep in mind that the group No Labels has said they would run a unity ticket if by Super Tuesday it looked like what it was going to be was a Trump-Biden race. So just watch for that. Someone like Larry Hogan or Joe Manchin, of course, the senator from West Virginia, who is no longer going to be running for re-election, to that seat, to see if someone else, a third party, could come into the picture here, because there's a long way to go until November. This is going to be the longest general election in modern political history.
Hey, Kayleigh, already feels like a year long already. Katie Lights, thank you, over in New Hampshire, with us around the table for some final thoughts. Gary Cohn. Gary, I know you don't want to talk about the horse race. We won't do that, but I do want to talk about policy.
Sure.
Tax cuts, tariffs. Let's start with tax cuts. Hardly been talked about. You and I caught up yesterday, and I have to say, I haven't talked about the tax cuts and all the money that's starting to come back into the country for the best part of 6 years or something like that. How relevant are yesterday's tax cuts to today's economy?
Well, the 2017 tax cuts. And I think they're really important. So this is back on the theme of normalization. So since we really got the tax cuts through that were signed December 22nd of 2017, we sort of had 18, 19, we had sort of two normalized years. 18 was sort of an implementation year, and we saw some really amazing things start happening. We saw real repatriation of foreign overseas money. Saw $1.5 trillion come back in the United States, because in the old tax system, corporations could leave their money offshore and they didn't have to pay U.S. taxes, so they brought it back. We deemed that money to be brought back, so we taxed it. It got brought back. I think when you see what's going on, and there's the manufacturing boom in the United States right now, which started in that period of time, a lot of that has to do with this repatriated money. Historically, when companies couldn't bring their money back, they had to invest it overseas. They built manufacturing overseas. They invested in property, plant, and equipment. Now that they're being taxed, no matter whether they bring it back or not, they're bringing it back, they're paying the tax, and they're investing. So you've seen the creation of manufacturing in the United States. This started in 2018 and 19 as companies started bringing back their repatriated money. You've also seen the growth that we've seen in consumption. You've seen the growth in the middle class's ability to spend money. Hardworking individuals got a real tax cut. And that's why I think people have missed the economic picture in the United States so badly. Everyone calling for this recession over the last year and a half, I don't think they understood the additional consumptive powers that the tax cuts created. We put real additional disposable income into people's pockets. And we did it on purpose. We made some very conscientious decisions to make sure that we were delivering real taxable returns or less tax to the hardest working individuals in America. And it takes time for that to feed through the system. It doesn't happen year one, and then we go through COVID, so you get all these, unnatural phenomena. And now we're back to what I say is more normal behavior. People are understanding what their taxable income is. Some of the programs that we put in 2017 have expired, and I'm happy to say that we're seeing some bipartisan legislation to reinstate some of those programs. There's a bill going through the House right now to reinstate some of the child tax credits, along with accelerated depreciation and the write-off of R&D credits. We think both sides of that equation, they were in the original tax bill. We think they're both important. You're taking care of both sides of the equation. We have to take care of hardworking families with children, and we have to incentivize companies to continue to do R&D and continue to invest in the country.
Gary, those individual tax cuts from 2017 are set to be expired. As you say, that helps individuals and taxes, but if you have a 10% tariff roll around the United States, that's a massive tax on consumers.
It is. So look, the tariff wall is something that needs to be discussed. I know it's a potential that's being discussed out there, and it's an idea. It's something that's being used to potentially pay for the future tax plans.
Wouldn't it negate it?
Look, I think we shouldn't get too far ahead of ourselves right now. As you said, the personal side of the tax reform package terminates in 2025. There will be an enormous amount of discussion to what happens between now and 2025. It will be important to what the makeup of Congress looks like, to what you are able to do, what you're not willing to do. Are you going to be able to do this through reconciliation? Are you going to be able to do it through normal order? Are you going to be able to do it with a simple majority? To do that, that means the Republicans would have to control the House, the Senate, and the White House. If you've got a split Congress, or maybe the Democrats control all three. If you're doing it through reconciliation, you're going to be able to do it through one set of policies. If you do it through regular order, you're going to have a much more of a compromise on what goes on here. So I think that the ideas that are being talked about right now are concepts. And this is what's interesting about the electoral process in the United States. And I think this is why it's important. This is a time where potential candidates and incumbents, and we actually have a couple of incumbents running, they get to tell us about their ideas of how they want to run the government. And these are ideas. If you look at the history, there are concepts and they're starting places. They're not necessarily ending places.
Bremo's got thoughts. I know when Lisa's got thoughts.
Well, no, to me, the idea, so many people have come on and said, we're taking it seriously. If Trump says something, we're taking it seriously. And Gary Cohn is saying, maybe not. You know, you got to look at the whole process. Unfortunately, we're out of time, but we'll have to get you back to talk about that.
Hey, Gary, it's good to see you. Thanks for this morning. Thank you, sir. Gary Cohn. Coming up next on the program, Netflix shares surging in the pre-market after reporting some stellar numbers. Those numbers up next.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Stocks are positive by 0.4% on the S&P 500. On the Nasdaq 100, all-time highs at a close yesterday, up by another 0.7%, helped up by the earnings. Netflix looking better than good. In the bond market, 2-year, 10-year, 30-year, believe it or not, a week away from a Federal Reserve decision. Yields are lower by a couple of basis points. Bramo 410.89.
And really, it's a matter of how much they push back against some of the enthusiasm that we've seen in risk assets, given the fact that we're still seeing about a 50% chance of a March rate cut being priced into markets. To me, that's one key question at a time where you're already seeing it priced in, and frankly, risk to the races, led by big tech that's delivering on the earnings.
Don't want to geek out too much, but how much have you heard about inflation revisions? This conversation started yesterday with Priya Misra of JP Morgan. Morgan Stanley's Ellen Zentner wrote about this as well. Policymakers would do well to defer judgment on inflation and the timing of the first rate cut until after the February CPI revisions. That's the focus of Ellen, and a lot of other people too.
People think that the data was messy because of some of the year-over-year and holiday types of comps. I will just say this, the longer this sort of rate-cutting parlor game continues, the more you're seeing long-term inflation expectations tick up. I'm looking right now, if you look at the forward break-even contracts, not to geek out too much, but 2.4%, down from a low recently of 2.1%. So it gives you a sense of how much people are really gaming out longer inflation, higher inflation for longer.
That's the next month or so. Let's finish on foreign exchange. The euro just south of 109 against the dollar, 108.89. Positive, though, on the session by 0.3%. Under surveillance this morning, Donald Trump taking another step towards a rematch with Joe Biden, the former president winning the New Hampshire primary, comfortably beating his only remaining challenger in the GOP race, Nikki Haley, refusing to back out. The next primary is in a home state of South Carolina next month. And AMH, the polls do not look good.
They don't look good. Also, look at the endorsements in South Carolina. One member of Congress at this moment, Ralph Norman, the only Republican member of Congress to back her in South Carolina. You have Senator Tim Scott. You have the governor of South Carolina. They're all going to coalesce around Trump. So the pressure is really going to mount on her and her campaign.
Kind of shocking that Tim Scott ends up backing the former president when it was Nikki Haley that helped put him there.
And also the optics of last night. He was just behind the former president, shining as he dropped out, and you're 100% right. Nikki Haley appointed him.
Yeah, the fact also, I mean, just everyone coalescing around Donald Trump. I just think about what this means for passing any kind of budget deal, what this means for any kind of border deal, what this means for anything, because anything that gives Biden a win is going to be negative for for all intents and purposes, the leader of the Republican Party.
And what it means for foreign policy issues as well. Check out this. The U.S. striking Iran-backed militia in Iraq after the group attacked an airbase housing American troops. Defense Secretary Lloyd Austin saying it came in response to a, quote, series of escalatory attacks against U.S. personnel in Iraq and Syria. The U.S. also conducting further attacks on Houthi rebels, striking 2 anti-ship missiles in the Red Sea. These two stories are connected. The election race of the next 10 months, 11 months, and what's developing in the Middle East.
Yeah, absolutely. So foreign policy become a little bit more important. What the administration wants to do is they don't want to see this conflict expand in the Middle East. So what they are doing is this laddered approach, very much in line with U.S. policy. They're going after training facilities, and they're going after the housing of missiles and all these weaponry that these Iranian-backed militia can use against the U.S. and the ships.
We've been talking about escalation about 3-4 months ago. Is this an escalation, or is this basically, for all intents and purposes, it has become a war, just sort of a low-grade war that is a hot war between the U.S. and Iranian proxies? And you can see that. Now the question is what this is going to do to Iraq, whether they're going to ask to pull out some of the U.S. troops that have been there. I mean, how much they really push back. And it really does feed into some of the election narrative.
Essentially in 2 proxy wars.
Yeah,
One with Russia, the other with Iran.
Absolutely. And what I think you'll probably see from the Trump campaign to really want to step up is that they decided to go for a big strike target when it came to going after Iran, and that was Qasem Soleimani. And reporting we have following that was that actually through intermediaries, individuals went via the Swiss and others, kind of frantically going to the U.S. after Qasem Soleimani was taken out, that we're done. We want to stop, and we want no longer of this bloodshed in the region.
Let's finish on this story right here. ASML seeing orders for its semiconductors more than triple in the last quarter. The CEO of Europe's most valuable tech company telling Bloomberg's Tom McKenzie the semiconductor industry has now bottomed.
We see the first positive signs of recovery. So at the beginning of the year, we'd much rather be a bit conservative. But as you also saw, had a record quarterly order intake, which also bodes well for 2025 and perhaps the back half of 2024.
So to be clear, this semiconductor market has now bottomed.
That's what we believe. We see the positive signs.
It's the latest sign of a resurgence in the industry. TSMC earlier projecting strong revenue growth in 2024. I have to clarify here that we're talking about a company that produces equipment needed to make the most sophisticated chips on the planet. Huge demand out of China for good reason, and I wonder what that demand is going to look like, or rather their ability to supply it in the years to come.
Especially if some of these sanctions and things go into play, and whether they're sort of front-loading some of that, given some of the increasing geopolitical risk. But frankly, we've heard from Qualcomm as well as other executives from Intel and beyond saying that this is only going to increase the race in China to develop their own chip, and it will hamper their ability to compete. So we shall see exactly how this develops.
Yeah, ASML seems to be benefiting from this race to hoard a lot of this technology before potentially more of these penalties come online. But at what point does that become beneficial, or how much does AI actually outweigh it? Because you also need this technology if you want to build out AI technology.
That stock is up in European traded by something like 7%. Elsewhere, Netflix absolutely soaring in the pre-market following a blockbuster earnings report. The streaming giant winning more than 13 million new customers in the last quarter, the best gain since the start of the pandemic. The jump coming as the company introduces a cheaper ad-supported platform and cracks down on password sharing.
We're really thrilled with our engagement trends domestically and globally. Our engagement is a bit impacted by our paid sharing. Think about it like fewer households using the same account. So as those folks spin off and get their own accounts and we win them over with our programming, that will normalize and continue to grow.
Michael Nathanson joins us now, Senior Research Analyst at MoffettNathanson. Mike, it's always good to hear from you, sir. Netflix just getting it done. Better than good. Walk me through where the revenue growth comes from now. Is it higher subs or higher prices?
Okay, good morning. It's probably a mix of both, right? So on the sub front, they have a lot of room to grow in developing markets, Latin America and Asia Pacific. On the revenue side, on the ARPU side, they are still introducing this advertising tier, and they're rolling that out at a lower price. So over time, they'll grow advertising. So they have a steady mix of, going forward, volume and price, and you're probably looking at like an 8 to 10% top line growth over the next few years because of that.
Michael, do you expect consolidation that Netflix is involved in? And I asked this after we were speaking earlier with Chris Marangi about just how much there's going to have to be this kind of tie-up cycle within media.
Yeah, it's a good question. Netflix won't participate in that tie-up cycle. Their competitors have never been weaker. The competitors, meaning the people who own cable networks, WB, Warner Brothers Discovery, Paramount, have to do something. The wild card here is Comcast. Comcast has Peacock, as you know, we talked about it last week, but Peacock is still not fully scaled. So there has to be some type of streaming consolidation and linear network consolidation. And I don't know how that gets done in the near term, but Netflix will not be part of that. They made that clear yesterday.
How much is Netflix independent in being able to crack down on password sharing versus kind of a shining light for the rest of the industry to be able to crack down HBO, Beyond, Peacock, et cetera, and capitalize on the eyeballs that might not be paying the bill?
Yeah, it's a really interesting topic. Netflix has been the first down this path because they hit maturity the first, and they also didn't really care about password sharing in the beginning. I don't think the others have the same opportunity because they don't have as much volume in programming. They probably don't have as much password sharing. We don't know. Netflix has quantified about 100 million homes that are password sharers. They've not yet told us how many of the 100 million have been converted. At this point, they probably don't know because it's all been mixed together. But I don't think the others have the same opportunity because they're still growing their business and they don't have the volume yet. So it's a real challenge for everyone else to actually play the same game that Netflix is playing. They're on a different plane in terms of what they're able to do right now.
Michael, when we caught up with Gabelli Funds, Chris Marangi, in the last hour, he was talking up consolidation in the industry. Where do you see consolidation coming from and who between?
It has to be some combination of Warner's, Paramount, and NBC Universal. Disney's not going to do any more deals. Netflix is fine. I don't really think Amazon and Apple are going to move here and buy other assets. So to me, it's the legacy media companies have to find cost synergies have to get streaming scale. So Jonathan, it has to be the people who are just, wounded now by cord cutting and the rise of Netflix, right? And again, because of either personalities or regulatory pressures or just kind of the unwillingness to come together, I don't think it's necessarily going to happen this year. So it's, to me, this is going to be more of the same for 2024.
Michael, I want to dig into that. Are you saying that the egos, as some of these companies are so large, they won't consolidate until they're forced to? So ultimately, you might have to see more pain first.
Oh, with that, thank you for saying that more articulately than I did. Yes, exactly. That's what's going on here. Is that you have to recognize you have a problem. And I don't someone is going to have to go to one of their competitors on their knees and say, hey, let's find a way to work together. And I don't think the people who run these companies want to do that yet.
So with that in mind, what is there to like about this sector? What is the top pick?
Well, I said this a couple of weeks ago. Our favorite stock idea is shorting Roku, but that's not for a lot of our people listening. So our favorite call is we have a short call on Roku, just because we think lessening competition in streaming is not good for Roku. But we also have a buy on Disney, with the idea that Disney has to articulate a profit story in streaming in 2024. They've been vague about their long-term profitability. Netflix will be at 24% profit margins this year, and Disney will be maybe break even by the end of the fourth quarter. So we say Disney in media, and it's really about their articulation of profitability. And hopefully in the first half of this year, we'll get more information on where they see their business kind of, heading towards in profitability.
Michael, thanks for the insight. It's always good to hear from you. Michael Nathanson there of MoffettNathanson. I think the best idea tells you everything that MoffettNathanson thinks about that space right now.
It's a short bet. That is all you can say. He laughed and then said, well, actually, it's shorting Roku because that's probably going to lose. And a really unenthusiastic explanation for Disney. But this really highlights the, lack of conviction if the ego is going to get in the way of trades that might make sense.
I won't start saying who's got the biggest ego in that space. No, I won't. But ultimately, that's never good, is it? That things have to get worse before they get better for leadership to concede that something needs to be done.
Because they have to agree to a price that they don't like. And that's the bottom line. And that's the reason why people have been surprised by how slow this process has been that everyone has expected for quite a while.
A lot of people like Netflix this morning. That stock is up by something like 10%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara. Hey, Yahara.
Hi, John. AT&T has delivered a strong fourth quarter with its wireless and broadband businesses growing at a faster pace for the second consecutive quarter. The telecom provider has been in a tough stretch of slow growth and job cuts. CEO John Stankey had embarked on a ruthless cost-cutting campaign that includes office closures and slowing investment into 5G and home internet. Apple is dialing back its auto ambitions after a decade-long effort to build a car. Bloomberg has learned the firm is now looking at an electric vehicle with more limited features, pivoting from its plans to make the vehicle driverless. The target release date for an Apple car has also been pushed back to 2028 at the earliest. And tech layoffs continue. German software company SAP plans for an 8,000 job restructuring to build out AI, while eBay will cut 1,000 jobs. That's 9% of its full-time workforce. It's the second round of reductions at eBay in a year. 60 other tech companies, including Amazon and Alphabet, have let almost 11,000 employees go so far this year, according to layoffs.fyi. And that's your Bloomberg Brief. John?
Yahara, thank you. We'll catch up with you in the next hour. Up next on the program, it is the year of the landing.
The market is pricing in very low chance of a hard landing. 35%, 40% chance of hard landing, I think is still there.
That's next on the program. You're watching Bloomberg Surveillance.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Later got asked to be the head of USAID.
I got that job when I was 36 years old.
36 years old. You're running USAID. How many employees does it have?
We had 11,000.
And did you feel qualified to run something that big?
I did until, the work started.
The grind higher continues on the S&P 500, positive here by 0.4%. Into the bond market, yields lower by 2 basis points, 410.31. And foreign exchange, the euro a touch stronger here, 108.96 against the dollar. That currency pair positive by 0.4%. Under surveillance this morning, it is the year of the landing.
The market is pricing in very low chance of a hard landing. 35%, 40% chance of hard landing, I think is still there. Because when you look at the details of the data, it's not all that robust. There is a chance that things slow down, or the Fed doesn't cut fast enough, or they continue QT long enough, and that's when that chance of something going wrong, I think we always have to be positioned for that.
Lisa asked for very specific numbers, percentages of hard landing, soft landing. The Fed waiting another round of reading on the economy with a PCE deflator on Friday. Michael Gapin of Bank of America expecting a March rate cut, saying, quote, what gets them to cut in March is the inflation data. Even if the activity side of the economy is doing well, it's the deceleration in inflation. As we roll into the March meeting, I think they get gradually more confident, Lisa, about the trajectory.
And you know who agrees with Michael Gapin? It seems like Jim Bullard, the former president of the St. Louis Fed, because yesterday in a Wall Street Journal interview, he was saying he expects the Fed to to lower rates before we get to that 2% target in inflation, and that cuts could come as soon as March. He wrote this: inflation on a 12-month core basis, you could get to 2% by the third quarter of this year. This is tricky because the Fed doesn't want to get into the second half of 2024 and inflation's already at 2% and you still haven't moved the policy. That would be too late. That was his verbs. So suddenly he's a dove after being a hawk and then having been a dove.
Remember, his was the dot right at the very bottom of the dot plot for all those years.
And then at the very top of the dot plot.
I just love hearing from ex-Fed officials because at least they're open and honest about how they actually feel and not guarded.
And you get the feeling that they're paving a path for the March rate cut, even if some people are worried that that's just going to unleash yet another round of analysis.
And of course, when you're a former Fed official, you don't have to worry about shaking up market expectations.
Well, you can do it anyway, but yeah, exactly.
You know, you're not going to move markets like you used to.
You're not going to move markets, and you're not going to hear anything from your colleagues in the next meeting.
It's another way of saying you're less relevant, but that's not what I mean. Kathy Jones joins us now, Chief Fixed Income Strategist at Charge 12. Kathy, good to see you.
Nice to see you.
Michael Gapin saying rate cut. He was on this program in the last 24 hours saying rate cut in March. Do you still think that's too soon?
You know, it isn't what I think the Fed ought to do. It's what I think the Fed will do, and all the communication keeps pushing us back to maybe May. So we have priced in, we have penciled in a May start to the rate cuts. And one of the reasons is in March, they still need to address the balance sheet, which we know is a topic. So we've heard from Lori Logan about tapering QT. I think that that's likely to happen at the March meeting. We have the expiration of the Bank Term Funding Program, although that can go for another year. So there's a few things in the way, and they also need that level of confidence that inflation is actually going to stay down. And I think that all pushes us more towards May than towards March.
But you think that there's a high chance that they could do it in March, even if they shouldn't necessarily do it, according to you? Where does that leave you? I mean, are you with Priya Misra leaning into riskier credit because it seems like the Fed's going to do everything they can to prioritize the soft landing, even over potentially making sure that the beast of inflation has been killed?
No, we're not leaning into credit. In fact, we're leaning the other direction just because the valuation. Now, you can't trade on valuation all the time, but the spreads are so tight. You might as well be in treasuries at this stage of the game when it comes to investment-grade credit. Even high yield, spreads are so low. Yeah, you can earn the coupon. You probably have a decent year, so we're still neutral, but we'd definitely not be leaning in at this stage of the game.
So where are you leaning in terms of treasuries? I mean, does this give you incredible conviction that we're going to get to a 3.5% 10-year, or 3% 10-year within the next couple of months?
Next couple of months is pretty aggressive, but I do think we get back, towards the 3.5% towards the end of the year. So we think the main thing is going to be bull steepening. As the Fed does start to cut, 10-year, 7-year probably hang in there in a range. We have fair value in 10-year around 380, 375. So we're pretty close to it now. Probably get a range around that level, around 4% for a while. But we think the main trend is going to be bull steepening.
Why it's steepening and why we're cutting, I think, is really important. If this is because inflation is coming in, great. And it's not because growth is collapsing, fantastic. Priya Misra on this program yesterday of JP Morgan turning positive on credit. Turning positive on credit because she thinks there's this window right now to be constructive on risk assets because ultimately the Fed can cut because inflation is coming in and we haven't really seen a collapse in economic growth yet. Do you see that window as well to be constructive credit, even with the price of the story being pretty elevated?
Yeah, I think this scenario is realistic. It's just that the market for credit's already priced it in. And so to lean in now is to get aggressive maybe a little bit later than you might want to. Also, we'll start to look at the default rates are picking up. We're not looking at underlying fundamentals for credit getting better. And the spreads are very tight. So what are you going to do with that? You're just going to rely on the Fed to cut rates. That's an interest rate play, not a credit play.
Is that another way of saying that you don't think we've paid the price yet for going from 0 to 550 on Fed funds?
No, I don't. When it comes to credit, I don't think that that's fully priced in. I think we're priced in Fed rate cuts and rescuing the economy and the credit cycle. And I think the jury's still out on that.
How concerned are you about a tick back up in inflation based on how the markets price things and based on what you think the Fed will do, not what they should do?
My feeling is inflation still comes down. I think we're in the camp that says that we're in a declining trend in inflation. I've never been in this camp that says, oh, the last mile is the hardest, or it's going to stay sticky forever. There's just not a lot of empirical evidence to suggest that's taking place. And you have a very soft global economy, too. So we do think inflation's going to come down. And I think the catalyst for the Fed cutting rates is that, you've got real rates now heading towards, levels that are really restrictive. So I think that is going to be the motivation. And if they go in March, that'll probably be the reason why. But I just lean towards May because of the messaging that we're getting.
Tomorrow we get the ECB meeting, and we're talking a lot about the U.S. and U.S. debt. It has been the main game in town for a lot of people. Are you starting to shift gears? We're seeing, for example, in Europe, Italians yields coming in dramatically. We're seeing an incredible rush to risk there. Are you following that?
Yeah, I think that there are some attractive plays in Europe because of the likelihood that the ECB has to go sooner and faster than maybe the U.S., maybe the Fed. So I think there's a play there. We actually kind of leaned into emerging markets as well because a rate cutting cycle in the U.S. is often very good for EM, but you have to be really selective.
Well, let's talk about that selectivity, even with the clouds over China right now. You've got China, big chunk of that part of the world, which is basically trying to stimulate demand for its own equities by apparently, and according to our reporting, considering using money from state-owned enterprises offshore to then buy into the equity market through Hong Kong. Kathy, they're cutting the RRR rate all over again. We've heard this story a million times. What on earth can they do to stimulate demand in that economy?
I think there's some fiscal space there, and they seem to be not using that directly. They're doing it indirectly through the banking system. I'm not really sure why you'd want to relever the stock market rather than use fiscal policy. But I'll tell you, frankly, I don't spend a lot of time worrying about Chinese bonds because we don't.
Can you be constructive EM without spending much time being worried about China?
Yeah, because I think that if China takes any step towards stabilizing their economy and improving things and reducing rate, that's APAC countries should benefit from that, APAC EM, and we're seeing a lot of positive things happen in, say, Mexico. So there's some EM where there's some room for movement.
Lisa, we've talked about this a few times already this week. Engines for growth. US is okay, Europe's not great, China's really struggling. If you think about the global economy as a three-legged stool, two of those pieces aren't looking good at all.
Which is interesting from the fact that maybe the U.S. is truly diverging, and it's because of the tech story, and also because maybe there are other smaller engines that people keep talking about, whether it's Mexico or whether it's India or whether it's some of these other areas. The idea that China is kind of moving away from center stage as they isolate themselves has really been a narrative over the past, say, 18 months.
Hey, Kathy, it's good to see you.
Good to see you.
Thanks for being with us. Kathy Jones at Charles Schwab pushing back against the idea of a rate cut in March. Mike Gaper in the last 24 hours. He thinks we may well get one in a few months' time. In the next hour, we'll have a bunch of conversations with the former House Speaker Kevin McCarthy, David Rubenstein of the Carlyle Group, Andrew Hollenhorst of Citi on when he thinks the Fed's going to cut rates. Mandy Zhu of the CBO is going to join us too. That is in the next hour on Bloomberg Surveillance. Your equity market on the S&P 500 shaping up as follows. Equities look like this. We are positive by 0.4%. Yields are lower by 2 basis points, 4.11 on a 10-year. And in foreign exchange, the euro, 108.94, positive by 0.4%. A week away from a Federal Reserve decision. The ECB is coming up tomorrow. And a lot of people still believe the ECB is going before the Federal Reserve. The third hour of Bloomberg Surveillance up next.
If you're losing more than half the electricity you put into electrolysis, is it a viable alternative to some of those fossil fuels?
Yeah. I mean, have you heard of oil? Have you heard of gas? I mean, you convert oil out of the ground, refine it, turn it to diesel, whatever you like, which is going to cook the planet. You've already lost 60 to 70%. I mean, yes, there is a conversion loss from not losing an electron going from wind and solar straight into the grid. That's why it's the lowest cost energy in the world. But there's a conversion loss. Oh my God, a conversion loss. The oil and gas sector, green hydrogen's got a conversion loss. It's like putting lipstick on a pig from the oil and gas sector. They have had a conversion loss since 1810, right? And remember, relative dollars, their dollar per barrel was $1,600. Let's not forget that. That's how they got going. Subsidies, $1,600. Wow, it's better than burning wood. Now the same companies stand in the road of green hydrogen and say, oh my God, it's not as efficient as us. We've only had a 200-year head start. Hundreds of trillions of subsidies, which we've swallowed from taxpayers. They should get none, and they want to do it in 8 or 9 years. Who would you back? I'd back us.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in. Will the
this be the last of its kind? No, this is the nature of capitalism. Get over it.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
We're in a soft landing right now. We're looking at the data. The data looks strong.
Look at the data. It continues to surprise to the upside.
That even if the activity side of the economy is doing well, as it is, it's really the deceleration in inflation.
It's actually not that easy to get inflation down that quickly. It's going to take more time.
As we get into this year, I think a big stepping back thing is that we're going to see what kind of economy we have.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowitz, together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 positive again after 4 days of gains on the S&P 500, 3 consecutive all-time highs. The data so far in the last week has been good. Retail sales hot. Jobless claims lower, consumer confidence picking up, and then we start the earnings for tech. Netflix knocking it out of the park. Bramo, another record high in sight.
This is sort of the kicker to all of the hand-wringing over, is it a problem? Does it make the market more fragile that the Magnificent Seven has driven so much of the gains that we've seen in U.S. markets? Turns out that's where the profit is, right? I mean, it turns out that essentially they are minting cash. The fact that they added 13.1 million new subscribers, that is the most since the heart of the pandemic, and now people have options like going outside versus during the pandemic when they didn't, and you can see those shares bouncing.
This always feels personal with you. Their stock is up by 9.9% in the pre-market, picking up again. More earnings still to come a little bit later this afternoon. So things are looking good, aren't they? Consumer confidence is picking up. The data seems to be okay. Unemployment's below 4%. Jobless claims sub 200K. AMH, you'd think this was very, very good news for the sitting president of the United States because it feels like it's going to be round 2 against Donald Trump.
Right. So it's good news on the economic front. Potentially the timeline is on their side. We saw that with the Michigan survey. Inflation is coming down. People are starting to potentially feel the economic effects that the Biden administration has been telling them they should be feeling. And the polls have been showing, well, actually, we're not. Now, maybe we're going into November and people are starting to feel better. And then the campaign last night puts out a statement saying, almost eagerly, we're excited to take on Trump because Biden was the only person who could beat Trump. Now, we should remind everyone, Trump only faced off in a general election against 2 people.
It's kind of bizarre, isn't it, when you put it all together? You've got the president eagerly awaiting another face-off with the former president, Donald Trump. At the same time, Nikki Haley's holding on. Is Nikki Haley going to keep holding on?
Well, the pressure's going to mount on her. And if you look at what she says, her sweet home state of South Carolina, she's behind 30, 40 points at the moment when it comes to former president.
I really think it's fascinating, the economic question. And we asked Gary Cohn in the last hour, why are people feeling bad if the economic data is so good? And I guess it comes down to, and what everyone's saying is just time. People need to adjust to 20% higher grocery bill. So when is sort of the statute of limitations on this? When do we say, okay, now inflation is not year over year, it's month over month and it's okay?
Gary nailed it. Cumulative inflation. It's the pain people feel over a period of time from 2020. It's not month over month, year over year, where we're going this year. It's about what's happened since 2020 and the sticker shock at a price level over the last 4 years. It's not going back.
And this, to me, is really a key question. If anyone has a paper on this, please send it. But what is sort of the maximum amount of time that people have to live with inflation at a certain level before it becomes sort of normal, and their wage increase to outweigh that in a more material way?
Equity futures right now on the S&P 500 positive by 0.5%. Let's whip through the price action for you. Bond yields look like this, down by 2 basis points, 410.51. The euro a little bit stronger, dollar weaker, reclaiming 109. The Fed decision a week away. The ECB decision a day away. Coming up on this program this hour, Mandy Zhu of SIBO Global Markets on the rally in the equity market. Former House Speaker Kevin McCarthy joining us around this table following Trump's victory in New Hampshire. And Citi's Andrew Hollenhorst looking ahead to key inflation data out later this week. We begin with our top story. Stocks continuing to climb. Mandy Zhu of SIBO Global Markets seeing more room to run, writing, quote, options market positioning is still biased towards further gains. Despite the S&P making new all-time highs, we're still seeing elevated demand for upside calls as investors position for further upside in the months ahead. Mandy, I'm pleased to say, joins us around the table. Mandy, good morning.
Good morning.
Why do you believe then, and let's build on this, the path of least resistance is still higher?
So, I mean, this is what the option market is signaling. It is what investors are actually putting money toward, is buying those upside calls. So, couple things that stand out to us. Measures a skew in the options market, which looks at the demand for puts versus calls. That's at a multi-year low across all the major global indices, particularly for Russell 2000. So to go back to the question of, is this going to be a rally led by tech? Now, more and more, we're starting to see, beginning November last year with the Fed pivot, people playing for potential broadening out of that rally. So looking for upside in the Russell, because we have S&P at all-time highs, but Russell's still down 20% from its peak, right? So Russell's still in a bear market. So that's kind of where the potential catch-up is, and that's where we're seeing the most elevated demand.
How crowded is positioning, particularly not just in sort of long positions, but also in this broadening out trade?
Yeah, to give you a sense of how extreme some of the positioning has gotten, at least in the derivatives market, if you look at the spread between Russell volatility versus S&P volatility, that's gotten to basically a 10-year high if you take out COVID. Right, and that's very unusual because typically when Russell volatility is rising relative to S&P, that's usually during times of duress when people are pricing in more recession risk. This time, the entire bid to that vol is coming from the upside.
Given that, how priced to perfection is this? I just go back to the conversation that you had, John, with Greg Jensen of Bridgewater in Davos, but there is this question of how fragile are some of these positions to just one data point that comes out that's highly negative?
Yeah, I mean, I think everything is really dependent on the economic outlook, so certainly things could change and move around pretty quickly, and we do see in the Russell, at least, it is the most reactive on economic data release days, whether that's CPI or FOMC. So certainly I think that the macro narrative can change, but at least in the equity market, kind of everywhere I look, that sense of optimism and the soft landing story, that's definitely what is being priced in.
What do you make of what's happening with the Russell versus, say, the S&P? You've got the S&P at all-time highs and the Russell still climbing out of a bear market.
Yeah, no, I think for me, for Russell to really, well, the reason why it's underperformed is pretty clear, right? It has much more overweight the cyclical sectors, and obviously growth has been slowing. I think this expectation for Russell to outperform, right now it's driven by lower rates, it's driven by this Fed pivot narrative, but I think for it to really be sustained to continue, you do need growth to pick up. So I don't think a soft landing is actually sufficient to get Russell outperformance. You actually really need growth to accelerate, which, given the outlook for this year, that might be challenging.
You keep going back to economic data. You don't talk about earnings. How relevant are the earnings this season?
Earnings are relevant, but what we see, one measure you can look at to kind of get a gauge of how much is being priced for earnings is dispersion. Implied dispersion, the DSPX index, tells you how much is being priced in the next 30 days. And what we're seeing right now is that implied dispersion is actually lower at the start of this earnings season than the last 8 quarters, so last 2 years. So in some ways, people are pricing in less moves on earnings, but I would say overall levels are still elevated. So don't write off earnings, but I think given the run-up in market, expectations have built such that the hurdle to get a significant move on earnings is certainly higher now.
As you speak, I just think about the risk and reward. And we were talking with both Michael Gapin as well as Priya Misra, and they were saying we have about a 65% chance of a soft landing and about a 35% chance of a hard landing. I know how you come up with these, 88.2 or 65.36, but if you take a look at what the options markets are showing, does it agree, or do you see a much higher probability of that soft landing being priced in?
I would say what is currently priced into to the option market is much more highly tilted toward the soft landing. So if you believe there is a significant chance or a meaningful chance of recession, then definitely I think there is value in looking at those downside puts. I think, it's not just the measure of put versus call. If you look at measures of implied correlation, which is, the measure that I always go to when looking at expectations of recession, because that is the one catalyst where it really drives correlation levels higher, right? In a recession, everything sells off together. Measures of implied correlation, forward expectations of correlation in the S&P, multi-year lows currently. So everywhere you look in the equity market, I would say it's really pricing for that soft landing.
How much is this people hedging for the upside because that's where they got really beaten up versus hedging the downside? And then just their ownership has not changed that much.
I think that's a huge part of it, and I think that's the main story in Q4. Right, going into year end, that was kind of what I was saying. It's really a positioning story going to year end, the performance chase. But we're now you turn the calendar. We're starting at the beginning of the year, and that is still persisting. So I think part of it really comes down to sentiment.
Mandy, enjoyed this. It's good to see you. Mandy Zhu there of SIBO Global Markets. Let's get you an update on stories elsewhere this morning. Let's catch up with Yahara Hackers with your Bloomberg Brief. Hey, Yahara.
Hi, John. Donald Trump is inching closer to a rematch with President Biden. The former president comfortably beat his only remaining challenger, Nikki Haley, in the New Hampshire primary. That's a back-to-back win for Trump after claiming victory over Florida Governor Ron DeSantis in the Iowa caucuses.
She doesn't win this. This is not your typical victory speech, but let's not have somebody take a victory when she had a very bad night. She had a very bad night.
Shares of Netflix are surging in pre-market trading after the firm posted its best customer growth since its pandemic peak. The streaming service added more than 13 million subscribers in the last quarter of 2023, exceeding the street's estimate. Netflix recently gained rights to WWE show Raw as its first live event content. And more turbulence for Boeing. Alaska Air says it found loose bolts on, quote, many of its Boeing 737 MAX 9 aircrafts, the CEO said in an interview with NBC. It comes just after United Air dropped Boeing's MAX 10 from internal plans without canceling its order. And that's your Bloomberg Brief. John?
Yahara, thank you. That story gets more and more shocking. More on that story a little bit later this hour. Up next on the program, Trump on the cusp of a third GOP nomination.
This is not your typical victory speech, but let's not have somebody take a victory when she had a very bad night.
This race is far from over. There are dozens of states left to go.
That's next on the program. Just around the corner, the former House Speaker, Kevin McCarthy.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
When will the ECB decide to cut rates?
We are on the right path, but I'm not going to shout victory.
Bloomberg Television brings you the breaking news and detailed analysis after ECB President Christine Lagarde's press conference.
The wages issue is what I think the ECB is really focused on.
June is our base case.
There is still a 50-50 chance of a rate cut coming just slightly before that.
In many ways, they should have been cutting already early to stimulate growth.
The ECB decides. Thursday on Bloomberg Television.
One hour, 16 minutes away from the opening bout. 4-day winning streak on the S&P 500 could well become 5. Equity futures on the S&P positive by 0.6%. Yields a little bit lower. We're down 2 basis points on a 10-year, 410.51. Under surveillance this morning, Trump on the cusp of a 3rd GOP nomination.
You know, we won New Hampshire 3 times now, 3. This is not your typical victory speech, but let's not have somebody take a victory when she had a very bad night.
New Hampshire is first in the nation. It is not the last in the nation. This race is far from over. There are dozens of states left to go.
Here's the latest this morning. The former president defeating Nikki Haley in the New Hampshire primary. Trump cruising to victory by 11 points with over 90% of ballots counted. Haley trading by over 30 points, Anne-Marie, in polls heading into the primary in her home state of South Carolina next month.
Yeah, the home state of South Carolina looks like she's up a very steep battle, Jonathan, with you have the former president up 30-40%. But when it comes to independents, Greg Valliere shows that this is potentially, writing this morning, where it's going to be a vulnerable spot for Trump. The major takeaway last night was Trump's potential weakness in November. There's no question that Trump has an enduring base of voters, but that base may not be sufficient to win the general election. He also continues to write that there is one area that's tilting towards Trump, and this is immigration. But what does this mean now, what's happening in Congress? Are Democrats going to be able to ink this deal? Because that would give a win to Biden, even though Republicans are definitely the ones that want something on this issue.
Let's start the conversation right now with Kevin McCarthy, former House Speaker, joining us around the table in New York. Speaker, good morning to you.
Good morning.
Let's get into it. Do you just assume Nikki Haley's going to leave this out and it's going to be Trump versus Biden all over again?
Yeah, I mean, think it's about 30 days before South Carolina. She's losing South Carolina. At the end of the day, I do not think Nikki Haley wants to lose her home state that badly. I think she'll probably pull out. I think it's difficult for her to win the majority. But the one advice I'd give to President Trump, it's about addition, not subtraction. His speech in Iowa was much different than his speech in New Hampshire last night. And what I would do if I was him, I would draw Biden into the campaign. Because every time Biden goes out, he shows his weakness. Biden cannot fix his biggest problem, his age. Immigration has now overtaken the economy. And the problem here is for Biden is he created it. There was no new bill that passed that created this rush of people across our border. It is just his administration policies. So he doesn't need the House and Senate to work out an agreement. He can do this administratively. So he's in a really bad position. He won last time by hiding. He cannot hide. So if I was Trump, I would start pulling Biden out. I would make the issue. Remember, a re-election is a report card. Your first election is aspirational. What are you going to do? Now there's going to be a report card on what you did, and no president has walked into a re-election in modern history lower than this, even Jimmy Carter.
Well, the former president has got to do something about attracting independents.
Yes.
Any evidence that he can do that based on what you've seen in Iowa and New Hampshire?
You can, because the challenge is looking back home. You sit here and you talk about data, what's happening in Wall Street. Voters are going to be voting on the passion of what's happening on Main Street. And if you look at what those interest rates are for a small business to get a loan at 12%, nothing's happening. So that's not going to change that drastically between now and November, and they feel it. They feel inflation when they go there. They know what the price of gasoline is. They see the border. Think of this. There's not one Republican in Congress elected from Massachusetts, and Massachusetts has a state of emergency based upon the southern border. You're here in New York. What does the mayor and governor say? Their number one issue is immigration. What is Illinois, a very big blue state governor? He's crying, don't send any more buses.
So on immigration, with Trump basically now being the de facto nominee, is that going to paint the fact that maybe this deal can't get done? Because why would Republicans in the House give Biden a win ahead of November?
Well, if you're elected, you want to solve a problem. The hang-up isn't with Republicans. The hang-up is with the president. Will he change his administrative policies that he put in place not by any vote? And he is holding back doing that. In the House, we have a very small...
I'm talking about the border Ukraine aid package, the supplemental that the Senate is working on.
Yeah. Well, let's talk border. Ukraine and supplemental is different. Do I think it gets done? I think it's very difficult. Every day that progresses, less likely. But remember, in the House, you passed the bill. When we were Speaker, we had a 4-seat majority. Well, we passed the strongest immigration bill, border security, that we've ever done. We haven't been able to do it when we had a 30-seat majority. And what you've watched, that sat over in the Senate, they have not acted. That's a Senate majority. The president hasn't taken any administrative action. You've got now the president even saying the border is not secure, something he hasn't said in a long time. He's got his own secretary saying something different.
All right, so if you think a supplemental doesn't get done, what about actually funding the government? How many stopgaps is it going to take?
Well, I think it's a mistake. Look, I did a continuing resolution to be able to solve this before the end of the year. The numbers are already there. If they continue where they are right now, and it's the far right, the Freedom Caucus of the Republican Party holding it up, you spend more money and you lock in Pelosi's policies. If they would just start moving the appropriation bills, do this now, they would spend less money, they would put more conservative policies in, and there would be a victory. So they need to focus in the next month to get that done.
Let's put the Freedom Caucus to the side for a second and talk about the main frontrunner for the Republican Party, Trump, and talk about some of his policies. Do you think that a 10% tariff, blanket tariff, is a good idea?
Look, the president has always been very open to think that America has lost in this. And I think he's changed the opinion of America when it comes to China. So that's not going to be the #1 issue people are voting on. They're going to be voting on the economy, on immigration, on gas prices.
But a lot of businesses are going to be voting with their money. And they don't want to see that. They think that it's a tax on the U.S. consumer and that the person who's going to really experience it is the person who's going to Walmart, the person who's going to Target. Do you agree with a 10% tariff?
Look, you're thinking this is going to defeat President Trump going in. It's not going to defeat President Trump going in. The president he has an American first policy, whether you agree or disagree with it. He has transformed what you look at Republicans and Democrats looking at China itself, not to have an advantage over America.
When it comes to the general election, we already saw it yesterday. Kamala Harris, President Biden, they're out talking about abortion. How difficult is this issue for President Trump if he wants to win these independents in the 7 swing states?
Okay, you just talk about the rally they had to talk about abortion yesterday.
Because they want to make it an issue.
Yeah, so how many times were they interrupted during this rally about abortion to go after Republicans? 14 times. 14 times the president was interrupted in a staged event that he thought he could attack Republicans about something. This is why I tell President Trump, engage President Biden. Go to a campaign with him every single day, because his policies have failed. We've had 5 embassies he had to evacuate. We have war. We've got now the axis of evil like the 1930s. We've got inflation. You have all the things that Trump can say you did not have under his policies. So yeah, abortion could hurt, but let me tell you one thing too. Abortion was on the ballot last time when I was leader. We won 5 seats in California and 5 in New York. We won in Oregon. We won in Arizona. You've got to take the issue head on, but I firmly believe when the economy is this bad, when you've got immigration just strong, that outweighs the other issues.
Hold on a second. The economy, a lot of people say, is very good. What do you mean it's bad?
Well, just what I made the point before. You talk about data and you say the economy is better. Go out to the American public. Leave New York and go out and listen to where
on Friday so that people are starting to feel better about the economy. Michigan consumer sentiment. Gasoline prices in New York now below $3 a barrel.
It's $5 in California.
Well, that's also some state issues when it comes to taxes. You know that.
All right, there's homelessness everywhere you go. That's a Democrat-run state. People feel something they haven't felt before. If you look at a poll in California, you look at independents think immigration is a #1 issue. Even Democrats, it's a 70-30. If you look at Democrats themselves, because remember, when you run for president, you want to bring your base and you want to expand it. Well, the majority of Democrats think President Biden is too old. If you want to talk data, if he gets reelected, there's a higher probability that he doesn't finish out his term based upon his age and the vice president comes in. She's not very popular for the ticket itself. You've got internals people still talking about. You've got people who ran Obama's campaign openly saying, if he's on the ticket, we lose. You've got Democrats worried if they have to run under his ticket. You've got those who've run for president before saying you should switch him out. That's not strength going in. That's why I believe the sooner we get 2 individuals debating It's a benefit to the country.
Well, let's see if even both of these individuals get on the stage and debate. But Speaker McCarthy, before you go, we have a few issues we have to ask you. One, do you think Speaker Johnson is going to get a motion to vacate like you were suffered and lost your gavel?
I don't think you can. Look, that was 8 Republicans. One person made the motion. It was 8 Republicans, so you had support in 94. But you watch what transpired after that. You went a month and you couldn't find somebody. And the top of the people who had the capability of doing the job got knocked out. So I think internally people look at that. And it was really based upon one member who moved it. He didn't want an ethics complaint to come forward. And I saw ABC yesterday, it's coming forward. So he's willing to disrupt the entire government to try to protect what he has done privately he doesn't want out. That's going to come out anyway.
I don't think enough people know your story. From flipping cars as a student to winning on the lottery, I think the first lottery, and buying a deli franchise. I think this is really important. Do you think that your party has left behind that traditional conservative vision of equality of opportunity and upward mobility? Do you think that the former President Donald Trump understands the essence of being a conservative in America?
Well, I think there's a debate about conservative, but I think he understands the entrepreneurship behind it. I mean, my story is, too. I grew up in the town of Bakersfield. Father, a firefighter, moved furniture on his days off. I didn't have money to send me away to college, so I went to community college, but I always had a work ethic. So I met a guy that had a car dealer's license. He happened to own a liquor store, and I paid him $100 to take me to the LA car auction, and I flipped cars. Now, it was illegal, but I didn't know it at the time. But I would go visit my friends who were away at college, and this weekend I was going to go to San Diego State, right? So I go to the grocery store to cash a check the day before the lottery starts, so I buy a lottery ticket, and I win the lottery. Now, it's 1985. It's only $5,000, but this was before Biden inflation, so it was something, right? And so when I came back, I took my folks to dinner, and I took the majority of the rest of the money, and I take risk. I put it into one stock. Yeah. I made 30% on my money in 6 weeks. At the end of that semester, I took a break, and I tried to buy a franchise, but they wouldn't sell me one because I was only 20 years old. The other thing, I never give up, so I opened my own deli, not a franchise, and I did pretty well. And at the end of 2 years, I sold it because I wanted to finish college. I now had money to pay my way through college.
So I imagine you're not going to open another deli. What are you going to do now?
Well, the end of the story is...
Cabinet secretary?
No. There was the local congressman. He said, be an intern in Washington. I didn't know the man, but I thought he'd be lucky to have it. So I applied, and he turned me down. But I ended up getting elected to the seat I got an internship for. Look, I believe the very best in America. That America is more than a country that's an idea. We need good people in there to serve. I will do whatever to help. But I'm going to go back to my entrepreneurial roots and
my
do some
Bloomberg's
things to help
lighting
the
up.
economy.
Got 5 seconds. What stock did you buy?
You know, it was back in 1985. It's called Fur Vault.
Fur Vault.
Remember, this was the day of Dallas. They were selling furs to Neiman.
On the product may read "Made in the USA," but the sign on the CEO's door often says, Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
Live from New York City this morning. Good morning. 4 days of gains on the S&P, 3 consecutive all-time highs on the S&P 500. The benchmark in America better than good. On the Nasdaq 100, a record high at the close yesterday, up another 0.9%. The Russell doing okay as well, better than okay, up by more than 1 percentage point this morning, up by 1.16% on a Russell 2000. In the bond market, yields look like this: 2-year, 10-year, 30-year. Yields lower by 3 or 4 basis points, 4.09% on a 10-year, down by 6 on a 2-year yield, 430.35. We're down by 3 on a 30-year, 433.29. And just to finish on foreign exchange, the ECB tomorrow, the Federal Reserve a week today. In the FX market, the euro 109.10. We're positive here by 0.5%. Under surveillance this morning, Donald Trump on the cusp of a third GOP nomination. New Hampshire voters handing him a decisive victory with over 90% of ballots counted, making a Biden-Trump rematch all but likely. Former UN Ambassador Nikki Haley vowing to stay in the race, looking ahead to the next primary in her home state of South Carolina in February. The former House Speaker Kevin McCarthy on the program just moments ago, suggesting that maybe Nikki didn't make it that far.
No, and he thinks that the sooner everyone can get around Trump, the better it'll be, because he thinks Trump needs to be talking about not Nikki Haley, but needs to be talking about Biden. He really, the speaker, former speaker, really thinks Trump needs to be bringing Biden out now and going up and against him on policies. Interesting, though, Jonathan, one thing the speaker certainly didn't want to talk about was abortion, and this is going to be a main driver for Democrats to want to get out votes.
This goes back to something we've talked about in the last couple of days. Traditionally, we'd sit here on the program and say it's all about the economy. It's always about the economy. But if you think about more recent votes, particularly the midterms, it's been about other issues. Abortion being one issue, immigration being another.
Honestly, I was taking a look at a couple of different research pieces on why people don't feel better about things, considering that all of the economic data is great. And it's not just the fact that inflation cumulatively has been high. It's also the war. It's also the biggest amount of strife within the American population in a long time. This kind of harkens back to 1968 with a similar kind of feel.
Yeah, absolutely. Foreign policy, while it's not the real reason why Americans go out to vote, it's certainly an overhang, especially when it comes to the youth demographic. Biden was interrupted yesterday. The former speaker was correct. But about the war in Gaza, it wasn't about abortion.
The scars of inflation, I just want to pick up on this. It's amazing that we can have people come on the program and talk about how bad the economy is and still connect with voters when unemployment's south of 4%, jobless claims is south of 200K, the equity market's at a record high on the S&P 500 and on the Nasdaq, and growth as recently as the third quarter was something like 5%. And you can do it because there are so many people in this country still scarred by the inflation of the last few years. Even if you can sit here and make the case that disinflationary trends have emerged and will continue and inflation will slow back towards 2%, you can't get away from that issue.
Disinflation is a hard story to tell. And honestly, I think that that's the key. At this point, though, I don't understand a lot of the sentiment data, and we are seeing it inflect higher because right now what you're seeing is otherwise incredible strength. I mean, as these earnings come out, people signing up for Netflix in this incredible way. I mean, the people have money to spend, and a lot of people said, you know, we were in the depths of the pandemic. We actually have climbed out And that, the base case right now is a soft landing, even with the inflation that we've seen and the fact that it's going to come down.
You mentioned Netflix. Let's look at the stock in the pre-market, absolutely flying, surging in pre-market trading after reporting its best quarter of growth since the pandemic. 13 million customers signing up in the fourth quarter thanks to a cheaper ad-supported option and a crackdown on password sharing, and management hinting at more price hikes ahead, saying this: as we invest in and improve Netflix, Anne-Marie, occasionally we'll ask our members to pay a little extra to reflect those improvements.
I think it was thanks to David and Victoria Beckham.
You mentioned that.
Yeah, I think that was this blowout documentary they had. People, it was one of their top rated. People loved watching it. My parents watched it and then signed up for Netflix.
13.1 million people decided David Beckham, that's it, I'm in. I mean, there's a lot there. I don't know about that. I'll let you have the David Beckham beat, but I am curious whether we go forward and we see that this sort of password sharing crackdown works for others, or if this is just Netflix and the sort of investment that they've done in content.
Well, clear two structural issues that have helped boost this name over the last few months. The ad tier is one, and the password sharing clampdown is another. And it's interesting, after you absolutely smash estimates for every region on the planet, that we're talking about price hikes now. If that's where the revenue growth is going to come from, what's it going to be? Actual subscriptions or price hikes on existing subscribers?
And if they can have a bigger base to hike prices, then they're in good shape. All I can say is the advertising thing. Would you actually pay more to not see an advertisement at the very beginning for a couple of 30 seconds? Seriously?
Waste of time.
Really?
Yeah, don't you do that?
No, I don't.
Yeah, I'll ad-free every single time.
Really?
Yeah,
I'm actually curious. I want to see what different people, how their marketing techniques are working.
I just don't want to waste time watching commercials.
Time is
anyway,
valuable.
That's just me.
Okay, all right.
We are the same person. It's okay. You're allowed to have a different preference on the issue.
All right.
I think we'll all share the same opinion on this story. Loose bolts were found on many of Alaska Air's Boeing 737 MAX models, according to the company's CEO. The findings come as airlines conduct inspections of the jets following a mid-air panel blowout on one of Alaska's flights earlier this month. The Alaska Air CEO telling NBC he's angry and frustrated and wants to know what Boeing is doing to improve their quality programs. I have to say, I know it's a word that's overused in this story, but just another absolutely shocking element to this, that they've gone away, they've checked the planes, and this is what they've found.
Okay, this is so unusual that you have executives, top executives of airline companies coming out and publicly or even semi-publicly questioning the safety of a supplier of aircraft that they use. To me, this is a game changer. And I have to wonder if this amping up, I mean, honestly, it's so graphic. The bolts are loose. I mean, this is like, not exactly what you want to hear before you get on a plane.
No, and I know you've been checking whether or not you're flying Boeing or Airbus. I took an Alaska Airlines flight in November from San Francisco to JFK, and I looked back last night, and it was one of these Boeing jets, and I was quite concerned, but...
Retrospectively?
Yeah, retrospectively, I was concerned about the aircraft I took, and said my prayers. But in all seriousness, Boeing CEO is going to be in the hot seat today. He's actually on Capitol Hill. Bloomberg News reported, going to be meeting with some senators, and they're going to have a lot of questions for him.
That's the latest on Boeing and Alaska Air. Let's turn to the data. Key economic data due out later this week, including fourth quarter GDP and core PCE. Andrew Hollenhorst of Citi looking ahead to the data, saying this: while 2% growth and 2% inflation will look like another quarter of Goldilocks, data for the Fed, we remain skeptical that these soft landing dynamics will last. Andrew Hollenhorst joins us now for more. Andrew, let's get into that. What are you anticipating here? Re-acceleration of inflation supported by the easing of financial conditions in the last few months? What is it?
Yeah, it's interesting because we actually have risks on both sides now, I think. What we have on the activity side is the lagged effect of higher interest rates that we were starting to see towards the end of last year showing up in the data, particularly on labor markets. You have some signs that labor markets, which have softened, are just going to continue to soften. Now you have this really complicating factor of easier financial conditions, to your point, and that is re-accelerating some sectors of the economy, and we're seeing that in housing in particular, and that gets into the inflation issue, where we have shelter prices that are still rising rapidly. Even the official measures of shelter price inflation have not slowed as much as economists were forecasting. And then you look at house prices. House prices are rising 8 to 10% annualized. So there really are risks on both sides of the Fed's mandate. And I think that the risk is that we see this data and say, okay, 2% growth, 2% inflation, that's what we were looking for. We're getting it for a quarter. it doesn't mean that we're necessarily going to continue to get it.
Andrew, you've been warning about inflation being maybe a bit hotter than people expected for quite a while. Have you adjusted your view, though? Do you kind of come to the same kind of conclusion that even if on the margins you might have a bit hotter inflation, it is coming down enough for the Fed to cut rates more than you thought maybe 6 months ago?
Well, we've been surprised at how quickly core inflation has slowed. We actually haven't changed our view too significantly on when the Fed would start cutting interest rates. We've always had them cutting interest rates around the middle of this year, which was both on the idea that inflation would slow and that activity would slow. The Fed, like we were saying in that note, they're going to see this inflation that, core PCE inflation, if you focus on this, one particular measure, 6-month core PCE inflation is running below 2%. But that's where you get into, are you looking at a narrow measure of inflation, or are you kind of looking at more broadly what's going on with inflation? If I look at core CPI, that's running a lot stronger than core PCE. Now, it tends to run stronger. But if I look at the service sector in particular, that's where you're really seeing continued strength, and wages that are the most important cost for the services sector are still rising 4 to 5% annualized. So I really don't think that we're on a sustainable path to 2% inflation. Fed officials are saying they're not sure we are either, but then if you kind of listen to their full comments, it sounds like they're pretty convinced. So I think they're going to be convinced enough to cut interest rates. But are we really headed back to 2% inflation? No, I don't think so.
Given that, are you more skeptical of a soft landing than everybody else, given the fact that maybe the Fed's going to either have to reverse course and hike rates back up, or cut rates more slowly than people think and kind of boil the frog?
Yeah, so Chicago Fed President Goolsbee calls this the golden path, and this quarter we're kind of on that golden path, right? We have growth that slowed nicely from the third quarter. We have inflation that's slowing down, but I would call it a narrow path. There is a path to a soft landing. It is possible that inflation just comes down and the economy cools nicely and we don't go into a recession. But is that the likely case? No, it never has been likely. It's still not likely. Of course, markets are going to feel that it's more likely right now because that's what we're seeing in the data. A lot of the slowing in inflation has been slowing in goods inflation. That doesn't really have a lot to do with slowing down the domestic economy. That has to do with what's happening globally. And now look what's happening globally. We have disruptions in the Red Sea. We have shipping costs that are rising. There's no guarantee that goods inflation is going to slow further. It may even pick up from here. And then we still have the domestic issues in the services sector and the shelter sector.
Andrew, what's your latest work on that? Developments in the Red Sea, tension, not just there, but also some of the traffic through the Panama Canal has slowed for a very different reason. Have you done any work on that recently, on whether that's going to show up anytime soon?
Yeah, that's right. There's some good work that the IMF did on this actually some time ago in response to the increase in shipping costs that we saw during the period of the pandemic. And now we're seeing some of those same shipping costs rise. Now, to your point, John, this is not as generalized as we saw at that point. Red Sea is going to be more important for trade between Asia and Europe. As a U.S. economist, yes, that shows up for the U.S., probably not as directly as it does for Europe. But then you also have this issue with water levels, drought in the Panama Canal. That's also restricting trade. So the IMF puts the numbers together. They get a few tenths of a percentage point on inflation. I think that's a reasonable estimate for how much higher inflation you could see. And so not a total game changer. But this idea that inflation is just headed down, it's one reason that it could be headed back up.
Andrew, just quickly, just to wrap it up, looking ahead to next week, just a week away from that news conference with Chairman Powell, what's the number one thing that you and the team are focused on?
What we really want to understand is this a Fed that's looking to cut rates as early as March, or is this a Fed that's waiting to kind of take their time and move carefully, like Governor Waller said? I think we're going to hear Powell more in this careful camp, which would indicate more of a June rate cut. But let's listen closely. These things are changing quickly. If he sounds more dovish, then those expectations could be moving into May or March.
Andrew, thank you, sir. Andrew Hollenhorst there of Citi. Kind of on the fence a little bit there towards the end, Bramo.
Yeah.
When we get that first cut.
I mean, that's the issue, is that as much as people push back, it seems like the Fed isn't pushing back enough to get that March rate cut really priced out of the market.
That decision 1 week away. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Authorities in China are making another attempt to boost the economy, with the country's central bank cutting the reserve requirement ratio by 50 basis points. The move becomes official next month in a bid to free up lending and cash. China's government is also mulling a $278 billion rescue package for stock markets as growth worries continue. Tesla is telling suppliers it wants to start production of a new mass-market EV midway through next year. That's according to Reuters. Currently, Tesla's cheapest car starts at almost $40,000, but this reported model would start well short of that. The company will report earnings later today, with the stock down more than 15% to start the year. And more woes for Boeing. The FAA says a wheel fell off a 757 jet on Saturday at Atlanta's Hartsfield-Jackson Airport. According to a preliminary report, a Delta flight was preparing for takeoff to Colombia when, quote, a nose wheel came off and rolled down the hill. More than 170 passengers were aboard and had to deplane. No one was hurt, and the FAA is still investigating. That's your Bloomberg Brief. John?
They've got a lot to investigate, haven't they? Yahara, thank you. Up next on this program, the future of energy.
We actually are very concerned that the larger global effort to fight climate change is missing a major focus on developing and emerging economies.
That conversation coming up next. You're watching Bloomberg Surveillance live from New York City this morning. Good morning.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question its industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg.
Live from New York City, good morning. Your equity market positive by 0.5% on the S&P 500. Yields lower by 2 or 3 basis points. 4.0993, a week away from a Fed decision with equities at all-time highs, Lisa, for a third consecutive session yesterday.
And really, while this has been driven by big tech, as we were hearing from Mandy Zhu earlier, this idea that people trying to lean into the Russell 2000, that sort of rotation story, just a little bit more as we think about what a soft landing looks like.
The Fed a week away, the ECB about a day away, the euro at the moment about 109 against the dollar. Under surveillance this morning, the future of energy.
We actually are very concerned that the larger global effort to fight climate change is missing a major, major focus on developing and emerging economies. 75% of all future emissions will come from 81 countries that today are classified as housing more than 3 billion people that live in energy poverty. We're trying to change that pathway for those billions of people to focus much more on renewables.
You can watch more of David Rubenstein's interview with Dr. Rajiv Shah, the president of the Rockefeller Foundation, tonight, Lisa, on Peer-to-Peer Conversations, 9 p.m. on Bloomberg TV.
The conversation has shifted around renewables, and I think that it's important to reflect that now people are talking about the practicality of it, and this really is important to discuss ahead of Tesla earnings later today. The head of a UK insurance company, Carl Schuker of Howden, was telling Bloomberg News, and this really speaks to the practicality of this, you've got length of repair times going up for electric vehicles, you've got the cost of the component parts going up, and you probably see more EVs written off because residual values are particularly low at the moment, and this is the reason why they are charging drivers twice as much to insure electric vehicles in the UK. So here's the question. It's not a matter of if people are going to shift their habits. It's a matter of when, and it's a matter of how they can make the financials work, and that's really been the massive discussion in a lot of renewables.
This came up a lot, I think, to start the year. This is not necessarily about changing objectives and the ultimate destination.
Correct.
It's about the speed we get there. I think you've noticed that with Hertz in the last week, and Ford has had reality check after reality check about demand for some of these vehicles.
And we've seen a much more practical tone, which is a reason why when we hear people talk about these highfalutin goals, there is an underpinning of practicality to it, which is a reason why someone who's really a pioneer in this is really compelling to talk to about investment as well as some of the hang-ups.
Let's catch up with David Rubenstein, the host of Peer-to-Peer Conversations and co-chairman and co-founder of the Carlyle Group. David, sir, it's wonderful to hear from you, as always. I just want to get into that conversation that you've had, and it's going to play out a little bit later. We've all heard of the Rockefeller name. Talk to me about the work of the Rockefeller Foundation. What were you focused on?
The Rockefeller Foundation is more than 100 years old. It has an incredibly illustrious name, of course. It's not as big as the Gates Foundation. The Gates Foundation is by far the biggest of these type of foundations. But the Rockefeller Foundation has a terrific name, terrific staff. I interviewed Raj Shah, who for the last 6 years has been the CEO of the Rockefeller Foundation. And what they're focused now on is climate change. They've done many other things throughout their long history. Right now, climate change is what they're working on, particularly in the emerging markets. And their hope is to get partners who will help them develop renewable energy sources for many people in the so-called emerging markets. And that's what their focus is now. And Raj Shah is an incredible individual, the son of Indian immigrants. He has an undergraduate degree from the University of Michigan, a medical degree from the University of Pennsylvania, but he decided not to practice medicine. He initially went to the Gates Foundation, worked on global vaccines, then was the head of USAID under President Obama, and now is the head of the Rockefeller Foundation. Very impressive individual.
David, as an investor and also as somebody who has conversations with a whole host of luminaries, how has the conversation around climate change shifted away from sort of, these big pronouncements and massive steps and the nuts and bolts of making it economically feasible?
Well, of course, almost everybody's against climate change or wants to do something about it, but getting it done is proving to be harder than we'd like. Obviously, the recent COP28 meetings had some progress, but we have to recognize that in your lifetime and my lifetime, we're not going to make gigantic progress. It's going to take many, many, many decades, if not a century more, before we really get to the point where we want to be. We have goals, of course, to get to net zero by 2030 or 2050, depending on the circumstances you're talking about. But it's going to take a long time because so much of the carbon is already in the atmosphere and isn't going to dissipate for decades. So we need to change people's habits, but it's very difficult to change people's habits when they don't see the benefit right away. Very few people change their habits because their great-grandchildren are going to benefit from it, and that's the dilemma we all have now.
David, what Raj is doing now with climate really was what he did with global hunger at USAID. How much does global hunger still impact what he's doing at the Rockefeller Foundation?
Well, the Rockefeller Foundation has had a long history in that area, and they backed Dr. Norman Borlaug, who developed the miracle seed that helped revolutionize the way agriculture is done around the world, and they've had a long history in trying to make sure that people have enough to eat around the emerging market countries. But that's not their main focus right now. Their main focus right now is climate change and trying to make certain that in so-called emerging markets, people have access to energy. Many people don't have access to real energy now, but particularly renewable energy, which they think will be much safer and much better for the world.
David, before we let you go, I got to say, as one of the founders of one of the biggest private equity companies in the world, do you believe in this idea that we're heading into a soft landing and that this year is going to be the start of a new cycle?
I certainly hope so. I think we've kind of gone past a likely hard landing. Everything can always change. The world's never certain of where we're going to go. But right now, I think the Fed has done a pretty good job of getting us to a soft landing. The question really is, when will the Fed begin to cut interest rates? Nobody really knows. My own view is that they probably want to do some cuts before the presidential election is in high season, so they won't be accused of helping the incumbent party. But also, they want to make certain that they don't have to reverse themselves. They don't want to start cutting rates and all of a sudden inflation comes back and they have to change their position. That would be very bad for the Fed. So they're watching it very closely. I suspect we'll see something out of the March meeting.
You expect the potential Fed rate cut in March, in other words?
I suspect it's something on the table, but it won't be a massive one. But I think they recognize that if they wait until the fourth quarter, or third quarter, I should say, it might be a little bit in the political season. So they probably want to get any rate cuts out of the way in the first and second quarter.
How many rate cuts are necessary to really reignite market activity? Are you basically saying, all right, that kind of March rate cut and sort of front-loading it is going to explode the scene on deal making?
Well, the market has already anticipated this, so if the Fed were to disappoint us, it would be not a good thing, I think, for the markets. But I think the number of rate cuts is less significant than the level of them, of course, and we don't know whether they'll have 25 basis point rate cuts or 50 basis point rate cuts, as they did in increasing rates. But I suspect they'll put their toe in the water with a 25 basis point cut in the not-too-distant future. That would be my guess. But again, I'm not really at the Fed meeting, so I can't really say for certain.
Well, we appreciate your guests, sir. Thank you very much. David Rubenstein there of the Carlyle Group. Looking forward to the program a little bit later on. They want to avoid being political, so they've got to make political considerations. It's always the tricky part of all of this, Bramo, when it comes to election year.
Honestly, a lot of people, and we heard this yesterday from Priya, this sort of conflict. They're not political. They don't want to do this. They shouldn't let it affect things. Will it affect? It's so unclear. I mean, this is the tough thing because they're either political or they're accused of being political. There's sort of no winning here.
Also, remember what happened in December. President Biden came out and said we're in a sweet spot right now in the economy and the Fed should not continue on their hiking path. Everyone thought we'll see signaling to Jay Powell to
that people we hear every day aren't going to be doing big deals before it because of the uncertainty. So I just think it's very tricky to sort of assume that you can parse these two things in perfect way.
You can't ignore it. You can't ignore it at all. Coming up tomorrow, you can't ignore this stacked program on Bloomberg Surveillance. Virginia Governor Glenn Youngkin, Senior White House Advisor Amos Hochstein, Paul Taubman, PJT Partners CEO, and Deutsche Bank Chief U.S. Economist Matt Lazzetti. All of that coming up tomorrow, a week away from a Fed decision, a day away from an ECB call, and President Lagarde. Round 3 for President Lagarde in the last week. What did we say? It's the third news conference in the last week.
Yeah.
Round 3 comes up tomorrow. We'll take that in full on Bloomberg Television for you. In the equity market right now, going into the opening bell, 35 minutes away. Equities positive, 4-day winning streak, could well make this 5, up 0.5% on the S&P. Bramo, all-time highs yesterday and record highs in sight this morning.
What I'm watching is definitely Russell 2000, how much it's broadening out, in addition to tech earnings continuing to deliver massive amounts of cash to edify some of the rally we've seen.
Live from New York City this morning, good morning. This was Bloomberg Surveillance.
Later got asked to be the head of USAID.
I got that job when I was 36 years old.
36 years old. You're running USAID. How many employees does it have?
We had 11,000.
And did you feel qualified to run something that big?
I did until, the work started.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
From New York City, for our viewers worldwide, I'm Manus Cranny in for Jonathan Farrow. Here we are. We're cruising towards the 4th day of record highs, maybe in the S&P 500. Do you get vertigo up here, or do you buy protection? Countdown to the open begins right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up in the show, futures point to more record highs on the street. Netflix getting the tech earnings off to a solid start, and Donald Trump inches ever closer to that rematch with President Biden. We begin with a big issue, a critical 48 hours for markets.
Look at the data.
The data, GDP, etc., coming up.
PCE spending in the U.S.
GDP numbers, PC numbers are going to be very important for the Fed outlook.
Everyone believes that the next move by the Fed is a cut.
The question is when and by how much.
We're in a soft landing right now.
Growth is going to likely to surprise us on the upside.
We see strong growth, and we see that there is a risk of reacceleration in growth.
We do expect growth to remain positive as we look further out into the new year.
Baseline, I think you still need the economy to cool to get the Fed to cut.
What gets them to cut in March is the inflation data.
Inflation's coming down. It's coming down decisively.
There could be this stickiness to inflation, which of course makes the Fed's intended path a bit more trying.
The more they wait, the harder it's going to be to cut rates.
They're going to be taking a read on that macro outlook to figure out when to cut rates.
Joining me now to debate when the rate cuts come, it is BlackRock's Gaji Chowdhury and JP Morgan's Jack Caffrey. Good morning. So let's talk about, can they extend? Can they wait? Can they wait until the summer to cut rates? Let's start that conversation with you, Jack.
You know, I certainly think that you've seen a dramatic repricing of the expectations of whether you're going to get that cut in March. I would be more inclined to think we're going to get a very dovish statement because once the Fed does cut, they do tend to continue to cut continually. And so I think that they're going to want to wait a little bit longer to see a little bit more weakness of the soft landing, more evidence thereof, because the last couple inflation prints and employment prints have not been consistent with the sort of dialogue of a shift towards the aggressive cuts that many bond market participants have been pricing in as recently as a week ago.
Okay, so it's a question of whether they got the ammunition to go early, and then they got politics getting in the way, haven't they? Gagi, let me bring it to you. Should they extend? Is it folly to go too early?
Good morning, Manus. It's great to be here. Thank you for having me. I think given the totality of the data, I'll use some of the Fed's language. I think for March, it does feel a little too early. While inflation is making meaningful progress, and the markets are very happy about that, and again, at the end of next week, or sorry, at the end of this week, we expect to see more progress on the PCE front. I still think that the Fed will give a nod to the fact that inflation, services inflation, is still sticky. March, in my opinion, a little too soon, but I do think they start soon thereafter, probably by the May meeting, and then get out to about 4 rate cuts for 2024.
Yeah, the magic PCE, the 3%. Will we break that level, and how much will we do that by? We'll come back to that in just a moment. And investors are bracing for the key U.S. GDP and PCE prints. The data will add to the debate over the Fed's next move, and that debate already playing out for central banks around the world. Mike McKee is with us now. Mike, a very good day to you. We've had policy on the move in Asia. Lay the table for me.
Well, we've had good news in the United States. We're expecting reasonably good news tomorrow. But in China, of course, the news has not been as good about the economy if you accept the fact that their numbers might not be right. So the People's Bank of China today announcing that they are, in a week, going to be cutting the reserve ratio, the amount of money banks have to keep on hand, and that, in theory, will add some liquidity to the overall markets. But there is general agreement among analysts that they're probably not going to get much from this, and they need to do more. So we'll keep an eye on China. Now, in Europe, we get an ECB meeting tomorrow. What's going to happen there? The betting is still that they don't cut rates, but look at what's happening with the economy. The numbers, except for the services PMI in the UK, everything's in the 40s, suggesting contraction, nothing getting better. It is still an economy in trouble. So what, if they don't do anything, do they say about when they might do something? That's kind of going to be the question of the day overall. Bank of Canada meets today, but they're not expected to do anything until April or June. The interest rate futures for the European Central Bank say the same thing. The Fed, right now, we priced out over the last couple of days the idea of a March cut. Suppose it could come back if the data are bad tomorrow, but the betting now is that we'll see it in May, and the Bank of England in June, although after the PMIs in the UK today showed prices rising again, inflation going up. There are questions about whether even that will happen, Menace.
Yeah, it's this magical glide path, isn't it, Mike? Thank you very much. Let's see what the GDP is. And, of course, we get a little bit of PMI here in the U.S. in just under 40 minutes. We'll return to Mike for that. Gagi Chaudhry and Jack Caffrey are my guests this morning. Here's the thing. We've got this Goldilocks kind of scenario for equity investors. I read a wonderful note which said, don't get vertigo here. Stay fully locked, stay fully loaded, stay fully invested. Gagi, you're smiling, but you know what? That smile could be on the back of all of our faces by the end of the week. Do you get vertigo here cross assets?
Honestly, I think this is creating some immense opportunities in the marketplace. I'll start with fixed income because I think that's where the opportunities are absolutely fabulous. You have these yields, especially on the intermediate part of the curve. When you look at the all-in yields you're getting in the IG markets and the EM markets and the high-yield markets, I think that gives you some real opportunity to own quality assets. So I think that is one area where investors have already gravitated to for all of 2023, and I think that's certainly going to be the case in 2024 as well. We will look back at these yield levels at above 4% on 5- and 10-year treasuries, and we will have wished that we bought them. So if you're sitting on the sidelines with cash, I think you're supposed to step in. With equities, I mean, it's a little bit tougher to have as much conviction, but I think here again, high quality is the name of the game. Stay invested, absolutely, but stay up in quality and stay large cap despite the moves.
Yeah, well, that involves a little bit more deep dive into the balance sheets, maybe, of some of those corporates before you pick up the bonds. Jack, let me take it to you. Absolutely fabulous, to coin the phrase from Gargi. Absolutely fabulous opportunity in fixed income, high yield, and IG. Concur?
Well, as an equity portfolio manager, I'm going to have to take the other side of that view. And I would certainly say, look, S&P's up more than 2% month to date. It seems unlikely that we can compound at a 2% monthly rate for the rest of the year and put up another 25% year after the gains last year. Valuations are on the richer side, and that's with an expectation of 11% earnings growth. But at the same time, 11% earnings growth is pretty compelling. I do think that we can hold and see earnings drive gains for the year. I agree with Gargi that moving into higher quality equities makes a lot more sense rather than being a little bit too cute and trying to time whether a market's starting to get short-term vertigo or not. But I do think over time, you are well rewarded from not only being in growing earnings, but growing dividends and growing cash flows being returned to investors in other ways. And potentially seeing companies taking advantage of some of that pullback in yields. You certainly saw with mortgages, where mortgage rates have come down 1%, and purchase mortgage applications actually have started to improve again.
I'm building that FICO score as we speak. Don't worry, I've only touched on. I've only got 4 months data, so I can't get the mortgage just yet. And before we shift back to Gargi on the fixed income side, Jack, you would say that the earnings recession is over. You must be quite heartened. You see Netflix up 10% overnight. We're waiting for some of the bigger tech companies to come this evening in terms of Intel, etc. Your first takeaway in terms of the boost in the arm from tech overnight?
Well, you certainly see that with the. In terms of, I would actually say there's a little bit of a mixed take on what you saw in some of the earnings last night. Netflix certainly posted, much higher subscriber growth, which has investors excited. The idea that they're expanding their business has investors excited. But then you look at a company like Texas Instruments, which still can't get us to the idea that we've actually managed to clear all the inventory situation, and which they pointed to areas like industrials and autos. And that comes back to this ongoing disconnect, if you will, between a still pretty robust ISM in the United States for services, comfortably above 50, and a manufacturing ISM slightly below 50, and where you have, again, an economy led by services. So that, I think, speaks to, the consumer has money, the consumer is willing to spend money, and that keeps things going, but you're not necessarily getting quite as much of the bang you would like on the more profitable corporate capital spending issues that Texas Instruments is highlighting in terms of some of those bigger ticket consumer items that might need some financing, like cars.
Yeah, but then you look at the ASML narrative in Europe, and they're talking about, a monster growth at the back end of the year. 2025 year will be another year of growth, and that's feeding the Chinese story. Gargi, let's just close it off with you. I'm fascinated. You say you favor adding a form of downside protection here. How?
Yeah, so a couple of things. I think, Jack mentioned this earlier, that we've had such a strong start to the year. We cannot possibly compound at this rate. There will be pullbacks in the equity markets. Now, you as an investor, if you've stayed in cash, should you continue to stay in cash? No, we think you should be invested. But protect your downside with buffered strategies. And that's a way for you to reduce the volatility in your portfolio, capture some of the upside in the equity markets, but also be protected. We like the moderate buffered, so up to 5% per quarter if you do have those pullbacks. I'd also say that, I'll reiterate that in a world where the Fed is poised to cut rates soon, we think in May or June, I think that is a period where intermediate duration fixed income up in quality, but also looking at actively managed ETFs like BINC, which give you that full yield in EM and high yield. We think that makes a lot of sense for investors. So protect your downside in equities and clip that coupon in fixed income.
There you go. That is the mantra of 2024. My favorite IB this morning is vol is cheap, making it compelling time to buy downside protection. Okay, team, stay with me. Gargi Chaudhry and Jack Caffrey on the markets. Joining me now side by side before the opening bell, it is Abigail Doolittle. Abigail, what have we got under the hood?
Well, we have some of these earnings movers that you all were just talking about. Let's start off with the shares of Netflix, which are popping sharply higher, up 10%. This, of course, on a solid beat of both top and bottom line estimates. But what has investors really wowed, as you were all just discussing, adding 13 million subscribers, a record fourth quarter, big growth there. New programming and the password crackdown continuing to help. Tesla up 1.5% before reporting its quarter after the bell. Profits expected to fall 39% year over year. On the other hand, revenues are expected to grow 6.4%, perhaps reflecting the price cuts that have happened over the last year or so. And investors will be looking to see whether or not they talk about 2.2 million deliveries on the year. And then finally, a big laggard, DuPont plunging down 13%, heading to its worst day since March of 2020. They pre-announced to the downside ahead of their February 7th quarter. They're talking about the first quarter being weaker than expected, citing China weakness. Investors not liking that. Again, the shares of DuPont down 13%, going in the opposite direction of the futures.
Okay, nice wrap up there, Abby, ahead of the opening bell. Coming up, despite losing New Hampshire, the Republican hopeful Nikki Haley is not losing hope.
This race is far from over. There are dozens of states left to go.
We head to the Granite State next for the very latest on the GOP race, right here on Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of pre-work before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Over. There are dozens of states left to go. And the next one is my sweet state of South Carolina.
And we're off to South Carolina. President Trump taking New Hampshire by a double-digit margin over the former UN ambassador Nikki Haley. South Carolina is the next Republican presidential primary coming up on February 24th. It is just 1 month from today. We're counting down. The latest polling, this is what we've got. Real Clear Politics showing Trump with a 30-point lead over Haley, and this is her home state. Joining us now from New Hampshire, it is Bloomberg's Katie Lyons. You must be shattered, but let's give it another stab today. Here we go. Trump took over 50%, Haley 44%. Do you think she's going to stick in there all the way, Kayleigh? Give us your take.
Well, Manis, that's what she says. She says she's taking this to her sweet home state of South Carolina 4 weeks from now, and potentially she could take it beyond that to Super Tuesday. Her campaign certainly has the resources. In fact, she raised $1.5 million in the 2 days following Ron DeSantis' dropout of this presidential race earlier this week. So she does have resources. There is going to be a big donor event for her where you are in New York just 6 days from now on the 30th, hosted by the likes of Ken Langone and Stanley Druckenmiller. But it's going to be a question of whether or not the donor money stays with her, given that she did get defeated by Trump here in New Hampshire, a state heavily populated with moderate Republicans and independent voters by a margin of 11 points, potentially not that strong second place showing that she and her supporters were talking about here in the Granite State. And the contest is going to get much more difficult for her going forward, especially with the Trump MAGA base potentially mobilizing against her. And she could face growing calls from within the establishment of the Republican Party to fall in line behind Donald Trump as the Republican nominee, as so many others have, Ron DeSantis, Vivek Ramaswamy, and South Carolina Senator Tim Scott included, all candidates who were candidates up until just recently. Something else I would note, though, is a memo her campaign sent out yesterday noting that on Super Tuesday, March 5th, 11 of the 16 states there have open or semi-open primaries. The thinking being she could still attract those independent, potentially former Democratic voters in those states and help up her delegate count. The thing is, though, if she couldn't do it here in New Hampshire, very hard to see how she's going to be able to do it moving forward. This is a very steep hill for her to climb, which is why this morning many people are saying that actually the general election, frankly, has already begun, that what we're heading for is a rematch between former President Trump and the incumbent President Joe Biden. It is a rematch that 70% of voters say they don't want, but very much seems like it is what they're going to get, Manis.
Well, the population sometimes don't get the real choice that they want. Kayleigh, thank you very much. Kayleigh Lyons, tracking the political jamboree around America. Gagi Chowdhury, Jack Caffrey are my guests this morning. Gagi, let me bring it to you first of all. Look, this is a back-to-back win for Trump. We don't know what happens in the next 30 days, but let's just run the assumption is that he takes the nomination. Now, we know that this is a tariff-orientated, tax-cutting-orientated, America-first-orientated narrative, and that could stretch for longer and larger than the previous campaigns that we've seen before. The impact, if at all, various people say to me, don't bet on either candidates, just get on with your strategy. To you, when you see this kind of coalescing around Trump, what does it do? What are the questions that come up in your mind?
Sure. So I think what I focus on, what the team and I focus on, is historically what have political periods and election periods meant for markets? How have investors responded? And of course, every election cycle is different. And I think what we need to focus on also is the backdrop of cash that's on the sidelines. So when you take all of that into consideration, what we have found is the 3 quarters that lead up to the election, there is a lot of volatility in the markets. People are a little bit more cautious and nervous about the markets. And of course, once you get that certainty, post-elections, the 4Q is often the best for markets after on election years. So I would imagine looking at this historical period, again, there's still a long time to go. November's far away. We're also in a Fed cycle. We're also in a global central bank cycle. There is so many things that's going to drive markets. I don't want us and other investors and listeners to get caught up by just this one narrative. Let's think about what else is moving in the markets. I do believe, though, that investors here are supposed to focus a little bit on up in quality and providing for protection in their portfolios. And then, like I had said before, accepting the opportunity in the fixed income markets.
And Jack, I think that's a very interesting point that Gagi makes. Goldman's have a note out this morning. They say actually it's going to be much more of a Trump would have a bigger impact on Europe and on the China and that correlation coefficient between China and Europe perhaps than it would here in the United States of America. For you, this is just going to be the start of what? A bumpier road in terms of the news cycle, but equity markets and bond markets, etc., just see through that.
I think on one hand, as Kayleigh mentioned, you effectively have now a national campaign, or a national campaign becomes much clearer much more quickly than you might have had in more contested primaries in prior years. And I think that takes out some of the volatility that Gargi was mentioning that tends to dominate early in an election year as you try to understand what likely policies might look like. I think the challenge or the opportunity in this case is we pretty much know what the Biden administration wants. It would be more a continuity of current economic programs and current beliefs. The Trump administration seems, or the former Trump administration, has certainly been talking about what it might like to do when it returns to power. And I think there's probably a little less difference in terms of some of the underpinning economic beliefs of both major candidates in terms of wanting to see more manufacturing in the United States, trying to see more reliance on tariffs, both of which might wind up actually creating more of the inflation that has made the average voter so unhappy in terms of the backdrop under which they operate, and which is sort of contrary to much of the narrative that we keep talking about in the financial markets. And I think that actually might make for an electorate that winds up breaking quite late. As I was watching coverage last night, you were having voter after voter going and saying, I decided on my primary vote on my way to the high school gym to cast my ballot, or I decided in the last 24 hours. And I think that's going to make for a much noisier year, probably later in the year than we've had in the past, when you had greater certainty on which way people were likely to vote, and we had more confidence in the polls.
Okay, Gargi, I just want to close off. We're going into GDP, we're going into PCE over the next 24 hours. How important is it for you and the team that you see prints at 3 or sub 3% on the PCE to close?
I think it is very important for us to see the continued deceleration on PCE. I think GDP less so. I think the expectation is that we're going to meaningfully decline from Q3 levels. Now, whether it's 1.7, 1.6 is less relevant. I think PCE extremely important. 6-month annualized, as we've talked about, is already back below that 2% level. We want to see it sort of maintain that sub 2% level. I think we need to take our cues from what Governor Waller said. This is a Fed that's going to be extremely cautious. They're looking at inflation to be moving down credibly and sustainably. And I think another PCE print of 0.2 or thereabouts is going to show them that sustainable deceleration.
Okay, let's see what the prints are and how we react. Gargi Chaudhry and Jack Caffrey, my guests this morning on the markets. Coming up, you got your morning calls, and we're going to catch up with Mark Lehman of Citizens JMP Securities. His call on 2024, right here on Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
towards the open, we've got a bifurcation in tech with Netflix bid up and Texas on the downside. Will we put another record high in? First up, let me get you some of your morning calls. Micro devices getting upgraded by the street. Research to a buy on potential of, guess what? AI chips. The analyst says AMD is the most attractively valued. Next up, Stellantis is caught to a hold by HSBC. The analyst citing declining market share, high inventories, and challenges to the car maker. Finally, Netflix is downgraded by Deutsche Bank to hold. The analyst says the streaming giant's leadership position is fully priced in the stock. Rocking it out, up 10% there. Coming up at Mark Lehman at Citizens JMP Securities. Let's see what he makes of Netflix.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Direct lending's on fire at the NYSE. We're going for a lit-up version on the S&P 500, rolling it over onto the cash market. Will it be day 4 of a rally? Tech is infused. It has Netflix bid up this morning, but Texas Instrument takes a little bit of a hit. So across the equity markets, we are bid up. Will it endure? Do you want to stay locked and loaded, or will you get a touch of vertigo at these record highs? Euro-dollar trades up 0.7%. That is based on the view the PMIs in Europe weren't fantastic, but they were inching higher than when we estimated. That gives the ECB a little bit more time before they need to cut. The dollar's had its biggest drop of 2024, and that infuses the euro bid. The curve, the short end of the curve is down by 8 basis points, and treasuries are down by 4, as you can see. That also puts a little bit of pressure on the dollar and gives the euro a bid. Crude is up by 0.5% this morning. We've talked about it. Have you watched the Beckham feature on Netflix? That's the question for you. The streaming service reports the best customer gain since the early days of the pandemic. Abigail Doolittle can answer the Netflix conundrum.
Yeah, well, this is a big one, Manus, for sure, and it's one reason that we have this big rally for stocks on the day. Netflix itself up 9.3%, its best day since October of last year. And I gave you the incorrect information a moment ago. Because of this strength for Netflix, we're actually looking at a 5th up day for the S&P 500. You're only as good as your information, so I'm taking responsibility for that. Relative to the Netflix quarter, they put up strong numbers right across the board. They beat sales, earnings, but the big deal is the subscriber number that came in at above 13 million subscribers, very similar to the pandemic type of numbers that they had seen when everybody was under lockdown and watching Netflix. It's a 4th quarter record. Operating income also tripled, almost tripled, I should say, to $1.5 billion from about $550 million a year ago. So tremendous strength there on the bottom line. Analysts had expected actually for subscriber growth to fall on the password crackdown, but it's done the opposite, it seems, as though people are willing to pay up to get their Netflix. The company is also talking about the idea that some of their own productions, such as Squid Game, that's really a positive. Analysts very positive. In fact, one analyst over at JP Morgan is saying that this is taking Netflix one step closer to global TV, although I thought we were global TV, Manus, so I guess there's a little bit of a competition there.
We are there. All hail the streamers. Abby, thank you very much. Let's stick with the earnings. Tesla reporting after the bell today, with the EV maker planning to start a new mass market electric car middle of 2025. That's according to Reuters. Ed Ludlow is with me from San Francisco. So BYD might be snapping at their heels and taking the crown in China, but it looks like we might get a new revamped lineup. Ed, good day.
Yeah, good morning, Manus. Look, it will come down to the basics of how many EVs does Tesla think it will build in 2024? The company has historically, well, going back to 2020, targeted 50% annual average growth on a compound basis. They built 1.8 million EVs last year, which, if you track that average annual growth on a compound basis, should see them say that they will build 2.5 million this year. The street says the guidance will likely be 2.2. That is the basics of it, but factor into the 4th quarter of last year some of the discounting and incentives that Tesla had to offer to shift vehicles in the final 3 months of the year, where in that quarter alone, you're right, it did lose the title of top EV seller to BYD in China. That will hit the bottom line. And so while it was a record quarter of sales in the quarter just gone, look at the bottom line where EPS is expected to drop around 38% year on year. Then there's all the awesome stuff. What are we going to learn about Cybertruck? What about humanoid robots like Optimus? And what about full self-driving beta? A new version was just released, and Musk posting in the last 24 hours, this might be the best version of that beta software yet. The retail traders really care about that. I know that I get excited talking about the sheer tech side of that story. The fundamentals for a car company are really important, but often when you think about the multiple this stock trades at, it's those kind of forward-looking AI-focused pieces of information that can be the catalyst going forward. And Elon Musk does tend to give big predictions on the earnings call, so tune in.
Yeah, well, that's what makes him sort of a go-to CEO for one-liners, isn't it? Ed, thank you very much. Tune in later on for analysis on what to expect. We've got Ben Callow of Baird joining me then. And a weak forecast at Texas Instruments, and this is the bifurcation in tech. The chip maker indicating a slump in demand isn't showing any signs of stopping. Simone Foxman is with me. Texas versus ASML. Simone, good morning.
Yeah, good morning. Bifurcation, the word that analysts are talking about this morning, too, Vital Knowledge, talking about the bifurcation and how this Texas Instrument result clearly shows that chip makers for the data centers, the AI, they're all doing well, but those like Texas Instruments, which manufacture some of the most basic semiconductors, a big part of industry and autos, are challenged. Sales were light in the 4th quarter, and no signs of them getting better soon. The Chief Executive Officer, Haviv Ilan, said that in the 4th quarter, we experienced increasing weakness across industrial and a sequential decline in automotive. Revenue was down 13%. That was a miss. Sales, biggest contraction in more than a decade, and the forecast is poor. For the 1st quarter, looking at sales of $3.45 to $3.75 billion, The street had estimated over $4 billion in profit expectations missing as well. The CFO telling Bloomberg in an interview, there's just been a different pace for different end markets. Auto demand, he said, is only just started to shrink, whereas that industrial demand has been doing so for a while. And so might be ending that sort of segment. Personal electronics has been a bit more stable. Again, as I said, Vital Knowledge talking about that bifurcation, the big word, and we're seeing those losses here. After, actually, we've seen a rally over the past couple of months, but not so much today. Manus.
Okay, nice context there, Simone. Thank you very much. And it's a mixed bag over at AT&T. You've got strong customer gains being overshadowed by the miss in terms of the outlook on the earnings. Isabel Lee is with the team. Isabel.
Hi, Manus. Mixed bag indeed. We have AT&T expecting an adjusted EPS of $2.25. That's lower than Wall Street's estimates of $2.44. But to your point, Wall Street didn't choose to focus on that. They chose to focus on that and instead not on the fact that the company posted a larger than expected increase in mobile phone subscribers. We have investors, including Vital Knowledge, saying that the knee-jerk reaction is not looking too good, especially after strong earnings from Verizon. But overall, the 2024 guidance isn't that bad. It's been a tough few months for AT&T. Shares are down around 10% in the past 12 months. The company has been dealing with heavy debt load and potentially high cost of cleaning lead out of its old copper phone networks. AT&T, now number 3 in the U.S., has fallen behind its peers Verizon and T-Mobile, especially when it comes to the development and the rollout of 5G and other next-generation networks. And under the new leadership, we've really seen some ruthless cost-cutting. The company has slashed employments, closed offices, and really sought to offload assets among the acquisitions it's done over the years. Manus.
Okay, Isabel, thank you very much. Let's begin our markets conversation with Mark Lehman of Citizens JMP Securities, weighing in on his outlook for 2024. This is where we jump up. If interest rates come down in the second half, we believe that could support the consumer confidence, resulting in a softer landing and improving trends across the consumer discretionary categories. So, Mark, there you go. We're all waiting to see whether the PC validates near-term rate cuts or back-ended rate cuts. But when I look at these markets, I'm just wondering, is the oxygen getting thinner at these highs? We're putting them in day by day at the moment. Or, as my last guess, we're very clear, remain invested, do not get vertigo.
I think caution is always merited, but I think the backdrop continues to improve. And you're seeing some of the reports today validate that thesis, right? You have a backdrop where rates are coming down. I think optimism is increasing. We saw that in the Michigan Confidence Survey last week. And the companies are just leaner and better. And I think you're seeing some of that cost cutting and some of that improvement from the companies start to play out. And thus profitability will continue to increase. And thus that should support the multiples that we're starting to see these stocks lean into, which are a little higher, as we all know, than they were a year ago.
Yeah, I mean, they are just shy of where they were at their record high in valuation. But when it comes to technology, I mean, there's the bid and the offer overnight, isn't there? There's the bid on the Netflix, which is subscriber growth, to the offer, which is taxes, and so being hit a little bit there. When you look at tech, you talk about the advertising environment, and that makes you coalesce around Meta, but it also on the consumer side with regards to Dash.
I do. I mean, Meta, as we know, I say this all the time. 18 months ago, they changed their name to Meta, and they don't mention the metaverse anymore. So that shows the power of what they're creating and what the transformation that the company has had with what they have done with AI and what they're about to show. Back in the day when I started, these were years we started to talk about advertising. We started to talk about the election year. We started to talk about the Olympics, which are coming up this summer, and we pointed to winners when it related to that. Those are online winners. That's going to be Meta, which we all know is creating a very powerful engine with a far fewer number of employees, so it's a much more powerful profit backdrop. And then I look at DoorDash, a company that beat the last quarter substantially, and I think about their outperformance on the operating expense line and what's going to happen in this election year and again in this Olympic year. So I think there's ways to win for companies like that. Obviously, multiples are improving, so you got to make sure they're improving their profitability outlook. But I think both those companies are doing that handily and will do so throughout 2024.
Now, when it comes to margins, and this is something that we can debate, we've had greedflation, raising in prices above the price of inflation. So we've had that. We've had extraction of costs. 60 tech companies have let about 11,000 staff go so far since the start of the year. It's not monumental. It's not a huge number. But it is an indicator that margins, there's going to be a push to keep margins. Is that going to be through sustaining price rises or taking costs out of these businesses? What are you drawn towards?
I think the answer is both. I think about this all the time, but I think this AI revolution that we keep hearing about and we keep seeing fruits of is kind of Moore's Law 2.0 in a way, where, in the 90s, we had Moore's Law saying double your capacity at half the price. AI is showing the power of that kind of improvement in efficiency at breakneck speed. And if Meta, who's as good an arbiter of what those efficiencies are, is telling you that they have a 40% increase in their advertising efficiency, it's a metaphor for the entirety, I think, of technology. You look at SAP, which was a forgotten stock a year ago, and they talk about their job cuts today, which are not insubstantial. But you look at all the money that they're going to plow back into AI and the cloud. Those are rapidly efficient ways for them to gain profitability. And that's across the tech landscape. You talked about Texas Instruments earlier today, which is kind of a have-not right now. You look at the haves, whether it's NVIDIA or what we saw in ASM, there's definitely winners. This is not the market's crashing, so watch Texan and worry about it like you do today. It's more about who's the winner, because there's market share to be gained, and it's rapid, and that's what we're seeing in the market today.
Yeah, well, certainly, SAP cutting 8,000 jobs on a big restructure. But of course, what are they putting the money into? They're putting it into AI. So it's a transfer, perhaps not a major wholesale cutting that's going on there. Mark, thank you very much. Great context around AI and Moore's Law. Coming up, Tesla results, they're hitting the bell.
What's the roadmap, really, for inflating those margins in the medium term is what the market's really going to be really focused on.
That is, of course, after the bell. Left a word out. We get the analyst take next. That's Bird's Ben Callow. Joining me next on Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, a significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity ports, trade corridors that connect countries that are landlocked to the ports.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Fresh data hitting the tape on the PMI. On the terminal, Mike McKee is side by side with me. It looks like a very comfortable set of beats. Mike, dig deeper.
Yeah, big difference between the United States and the rest of the world on these PMI numbers. Excuse me. U.S. manufacturing comes in at 50.3. It's the first time since earlier in 2023 in March that we saw a number over 50 signaling expansion, and it's the highest since October, I believe, of 2022. The services PMI comes in at 52.9. That is up from 51.4, and the global composite at 52.3 is up from 50.9. So strong beats on the U.S. Purchasing Managers Indexes, which completely are 180 degrees from what we saw out of Europe this morning. The Europeans pretty much all in the 40s, suggesting there is still contraction underway in manufacturing services and the composite indexes for most of their economies. One other headline, Manus, out just a moment ago, the Bank of Canada keeps its main interest rate at 5%. That was expected by everybody that Bloomberg Economics has surveyed. Governor Tiff Macklem is saying that the path to the 2% target will be long and slow, and the question now becomes how long do they leave it at 5%, which is sort of an echo of what we're seeing in the United States these days.
Indeed, but those are bang-up strong numbers, Mike, in the United States of America. Mike McKee on the data. So Tesla reports after the close today. Deliveries and demand are going to be the focus for the EV maker. Bird's Ben Callow joins me now with a preview. You have an outperform rating on the stock. $300 is where you point to. Good to have you with me, Ben. I like how you encapsulate the situation here. We have had demand skepticism, we've had price cuts, we've had outages in Berlin, we've had multiple headwinds. But set the table for me. Demand skepticism will be defied?
Well, what we've seen so far this year, there have been price cuts across different geographies. And so, they are using price as a lever to increase demand. I do think the refresh of the Model 3 and the rumored refresh of the Model Y should also help with demand in this coming year. And I also think that the way that the credits work for the EV tax credits at the dealer at time of purchase should also help with demand as well. And then, as we look at numbers this year, Tesla in the past has talked about 50% growth rate year over year on the long-term basis. Right now, we're at about 16% growth rate. The street's somewhere just north of us. So numbers are tempered, and everyone's kind of bracing for a year of maybe weak demand. Now, looking forward to 25, we're getting news out that they're looking to have the Model 2. This is the mass market vehicle, come to market and start production sometime next year. And these are rumors from their suppliers. That could boost volumes considerably and be a big catalyst for the stock this year.
Tell me this, it's the perennial question. Is Tesla a battery technology company, an AI futurist company, or a car company?
Yes, it's all three of them. I think that, we've seen this in an auto company. Energy should be a bright point of the business this quarter and definitely into 24, where it starts getting close to 10% of overall corporate revenue. And so that's showing itself as a real business too. AI is still out there. There's lots of skeptics, but I think this is the year where Tesla starts proving out that they do have the capabilities there. And, there's been the discussion around must-pay package, which is important there, as well as they start, moving more into AI.
Well, pay matters. We've seen that in Banky, Jamie Dimon, along with the outgoing Morgan Stanley CEO. Ben, tell me this. I look at China, BYD takes the top spot in electric vehicles in China. We know the national story there, that's fine. But then you look at the data about the growth in EV in China, and this is what we got for you. EV growth is set to slow for the second year this year. It will grow 25%, 11 million units this year, but that's down from 36%, down from 96% in 2022. Is the trajectory for China and Tesla's position in China materially on a downward trajectory, or is it a temporary interruption, and how important is that?
Well, I think overall, we always look at competition as versus internal combustion engine as you take more share there. Headlines would say that no one's buying EVs, but we've seen growth across China, across North America, across Europe. Now, a slowing growth in China, that could be a concern. So far, we're still seeing strong numbers out of China. Still early in the year, though. I do think price cuts can help, and definitely that the Model 2 coming to market, I think propels growth. As we look into next year in China.
What is it that gets me to $300?
I think us seeing trough margins is one big thing. Us learning more about Model 2 and how far along Tesla is. And really what they've been doing is, to use Musk's phrase, building the machine that builds the machine. I think that they're nearing finalization of the line, the design of the line to build this Model 2. To hear more information about that would be a catalyst. And I think, getting up north of 300 is when you start talking about Optimus licensing full self-driving to others, using the Dojo computer for other industries, licensing that as well. That's stuff that people are very skeptical about, but I think that can become a reality this year.
Okay. We'll keep an eye on that target. Ben, thank you very much. Let's see what the numbers deliver this evening. For some of the sector price action this morning, let's get across to Abigail Doolittle. Abby, what have we got?
Well, we have a pretty robust gain here today, Manus. We're looking at above average volume to the last 20 days. We have most of the sectors higher. And of course, we're looking at that fifth up day for the S&P 500 in a row, 4 record highs in a row, the first string of that since in about 2 years. Communication services, not surprisingly, leading the way, helped out by Netflix. Tech is also up there to the downside. Materials, as DuPont weighs on their negative pre-announcement, consumer staples, industrials. Let's dig deeper on that communication services sector, though, because it is part of the reason that we have the S&P 500 up over the last 5 days, gaining 5.9% over those last 5 days. Manus, that's the best stretch going back to November of last year.
Whoop, whoop. There we go. All held. Stay fully invested. Don't get vertigo. That's the note from UBS. Abigail, thank you very much. Abigail Doolittle on the sectors. Coming up on the show, we'll give you the market moving events that you need to slate in your trading diary on Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
We also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Fixed Income Fix. Watch Bloomberg Real Yield at its new time, Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
Equity investors have not caught vertigo. We've still got rising markets. We're waiting for IBM and Tesla to deliver their numbers. If we stay in the green here, there's going to be the fourth day in a row of record highs. Do you want to stay fully invested? Let me give you your trading diary for this Wednesday. Tech earnings continue. Tesla, IBM reporting after the closing bell. Thursday gets set for another central bank. The ECB delivers their decision. Christine Lagarde will guide you through the press conference. And the US strong GDP figures. Is that what we will get? Friday gives you the Amex reports. Have you been spending? And of course, the US PCE print ahead of the Fed's decision next week. That needs to come in at or better than 3% to maintain your investment in investment-grade credit and high yield, according to BlackRock. That was the conversation this morning on Countdown to the Open. I'm Manus Cranny. This is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Later got asked to be the head of USAID.
I got that job when I was 36 years old.
36 years old. You're running USAID. How many employees does it have?
We had 11,000.
And did you feel qualified to run something that big?
I did until, the work started.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Brokers Studio in New York City to our worldwide audience. Alex Steele, Paul Sweeney here, live on our Bloomberg Interactive Brokers Studio. We had some earnings last night, Alex. Netflix came out with some good numbers, stock ripping. So we'll break that down coming up. And then we've got some earnings after the close of auto company, I think, Tesla.
Some EV thing? I
EV
don't know.
thing.
It's kind of a small company.
We'll get a little preview there. We've got some smart people on that. We've got IBM after the close as well. So we're going to break down the stocks. We're going to talk to our Bloomberg Intelligence analysts and get the lowdown on what's happening on the company level with the stocks, with earnings, and with these markets. That's all coming up over the next couple of hours here on Bloomberg Intelligence. But right now, let's kick this whole thing off with Mr. John Tucker.
Yeah, green on the screen. S&P 500 adding to its record close. You have 8 of the 11 major industry groups in the index higher right now, and it is tech in the lead. Netflix up 13%. After that earnings after the close yesterday on the other side of the register, you have DuPont that right now is down 14% right now for DuPont. eBay rallying after pledging to cut about 9% of its workforce. And with New Hampshire in the rearview mirror, the election does matter to investors, but you won't see it right away, at least according to Amy Wu Silverman at RBC Capital Markets.
It's something that we are watching very closely, and I do think that the election this year is going to be an overhang as we head into November. It might as well be an infinity away for now. I do think we'll start to see pricing in the market, but it'll come a lot closer to November than it will now.
Let's do this eco data that you touched on, Paul. The S&P Global Manufacturing PMI coming at 50.3. The expectation was for 47.6. Remember, anything above 50, that's expansion. Manufacturing, that's the smaller part of the U.S. economy. The biggest part, that belongs to services. The services PMI coming in at 52.9. Expansion there, that was well above expectations. S&P 500 up 19 points. A rise of 0.4%, 48.83 on the index. The Dow Jones Industrial Average, 52 points higher. The NASDAQ 100 up 125 points. That's up 0.7%. And this Bloomberg Business Flash brought to you by Interactive Brokers. Interactive Brokers charges U.S. dollar margin loan rates from 5.83% to 6.83%. Rate subject to change. Learn more at ibkr.com/compare. We check the markets all the time. I'm John Tucker. Back to Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Brokers studio. Streaming live on YouTube, so you can head over to youtube.com, search Bloomberg Radio, Bloomberg Podcast. Anywhere you go, you'll find it there, and that's the good stuff. Hey, Alex, I see your fingerprints all over this, and I'm fired up. Lorenzo Simonelli, CEO of Baker Hughes, 11:30 Wall Street time. We're going to be chatting with him, aren't we?
We are. This is Paul's complete dream.
Love
is
it.
doing oil CEOs for a little bit. So Baker Hughes is an oil services company.
Yep.
They do the rigs. They do servicing for actual oil companies on and offshore, but they also do a lot of LNG build out. So that's like their new business that they're getting into. So if you're building a terminal to export, Lorenzo's one of your men.
We used to keep track of the Baker Hughes rig count. Remember that? That was like a piece of
I used to break that on
secondary
TV.
or tertiary data. It was like basically we didn't have anything
I
else
want to go
report.
to one of those rigs. Like I was just down in Aruba, and right off the coast of Aruba, I was sitting on my beach having my cocktail with the umbrella. There's a oil rig right off the coast.
So it's really hard to go to an oil rig offshore because there's like tons of liability issues. Going to a rig like inland is
Okay.
easier and still also very cool.
So I'm not going to get the helicopter ride out to the North Atlantic, landing on it.
Maybe we could take the radio show.
Yeah, we can take the radio show out there. All right,
We're
very good. So that's
working
coming up at 11:30. We'll talk a little energy, as I think we're going to be doing a little bit more around here, which is very, very cool. Had a big primary up in New Hampshire yesterday. We want to check in with Kaylee Lyons. She is the Balance of Power co-host. And Kaylee, is there anything for Nikki Haley to hang her hat on after yesterday?
Well, if there's anything, it's that the margin of victory for Donald Trump here in New Hampshire was actually smaller than we thought it might have been coming into the votes yesterday. The latest polling that came out on primary day showed him ahead here by 22 points, and ultimately he only won by 11 points. Still a double-digit margin, still probably not the strong second place showing that Nikki Haley and her supporters wanted to put up, but you could argue that it could have been worse. And of course, Nikki Haley came out of this loss saying, I'm not done with this. I am still fighting. I'm going to my sweet home state, she said, of South Carolina. That primary is coming up on February 24th. The question really is going to be, do donors stick with her, and can she withstand the attack she is likely to get more amplified now from Trump and his base of supporters heading to South Carolina, where she is polling, mind you, despite the fact that she served as governor there, some 30 points behind him right now.
I don't know, a month in politics is like a year in normal lifespan. And, you know, the Journal had an amazing breakdown of who voted for Trump and then who voted for Nikki Haley in terms of everything you could possibly think of. Issues, education, ethnicity, how much you make, I mean, everything. Are the people who voted for Nikki Haley really going to vote for President Trump?
So some of them, no, Alex, have suggested that they would not, that even some registered Republicans have said they would not vote for Trump in the general election. The distinction that needs to be made here, though, is general election politics versus primary politics. Nikki Haley was able to do as well as she did in New Hampshire with about 43% of the vote because there are a ton of independent voters here and moderate Republicans here. It's not necessarily like that in the contest moving forward, certainly not in South Carolina. And sure, 11 of the 16 primary states on Super Tuesday have open or semi-open primaries, so she could still pull some of those independent voters in, but it might not be enough to carry her over the finish line in the primary, even if that is the kind of support that would help her potentially win a general election matchup versus the incumbent President Joe Biden. And that independents that are trending more toward Haley's side rather than Trump's could be problematic for Trump, assuming he does become the Republican nominee. That suggests that that could be a weak point for him in a general election matchup.
So, Kayleigh, we all know, learning over the last, I guess 8 years, that the base support for former President Trump is so strong, and maybe that's a third of the Republican Party. I'm not sure how that math shakes out these days. Is the expectation that the Republican National Committee, the party apparatus, is going to fall in line behind the candidacy of President Trump here?
Well, you actually had Ronna McDaniel, the chair of the RNC, on Fox News last night after this result came out, essentially saying that Nikki Haley should end the race. That, it's very clear that the party is behind Trump at this point, and I'm imagining that those calls are only going to grow, even from more establishment Republicans who haven't fallen in line with Trump at this point. What I would just note here, yes, Trump does have that firm base of support, and yes, right now it does signal that even beyond that, most voters in swing states, the key ones that will ultimately decide the Electoral College and therefore the outcome of the election overall, are leaning more in Trump's direction right now. What could change that, according to polling we have seen, is if he is convicted of a felony. Keep in mind the day before Super Tuesday is when a trial is scheduled to start in Washington, D.C. on those 2020 election interference charges, the case that Jack Smith has brought. And if he's convicted of a felony, there are voters that would turn away from him. Maybe you would start to see a fracturing of that support a bit more. Of course, the hypothetical situation at this point, he is indicted, he is innocent until proven guilty, but that's something we have to keep in mind as this moves forward, is there's still almost 6 months until the actual Republican National Convention.
So there's another problem that's percolating. And that's the fact that the U.S. economy is doing really well. I mean, you take a look at the PMI data. I realize it's just one data point, but manufacturing PMI is at its highest level since October of 2022. Stock market at all-time record highs. Services holding up really well. Orders growth and demand for both of those sectors doing really well. How do we expect those on the Republican ticket to talk about that at this point?
Well, what you hear a lot from the Republican side, and I actually posed this question to the Republican governor here in New Hampshire, Chris Sununu. I said, look, stocks are at a record. You have unemployment below 4%. The economy is hanging in there. Is this not something that any president would want to try to replicate? And he pointed out that prices still, a lot of them are higher than they were before Biden took office, that you have families that are struggling in terms of housing and being able to provide, and that is still a very real feeling. We are starting to see, it seems, a turn in sentiment in the more positive direction. There may be a lagged effect of that actually showing up in polling. But right now, yes, despite all of the economic indicators we look at here at Bloomberg, it's not reflected in voter sentiment, and certainly not not reflected in the approval numbers on the economy we're seeing for President Biden. So that is a big issue at play here in this election. I would just point out that in addition to the economy, something else we heard here in New Hampshire and in Iowa as well is that border security is equal to, if not even more important on the minds of voters right now than the economy is. And border security is going to be very spotlighted in the coming weeks and months as Congress is trying to address that issue as we speak.
All right, Kaylee Lines, thank you so much for that. So much for your reporting over the last several days from New Hampshire, Kaylee, and the entire team up there. We had a bunch of
Oh my God,
folks
I
up
think
there.
Kaylee's up 4 hours.
Yeah, I know, exactly. So Kaylee Lines, we appreciate that. She's Bloomberg television co-host, of course. Let's pivot to the market here. It's green on the screen as Mr. John Tucker's been reporting this morning. The S&P 500 up 0.4%, 48.85. So we're on that 5,000 watch. Dow Jones Industrials 37,900 on the 38,000 watch. I like the round numbers. Let's check in with somebody who does this stuff for a living. Anna Rathbun, CIO at CBIZ, maybe CBIZ, Investment Advisory Services, Independence, Ohio. That sounds like really right smack in the middle of Ohio, if I had to guess. I don't know. Anna, thanks so much for joining us here. Again, I thought we might take a meaningful pause here in the first quarter with these markets, given the real rip we had in November and December. What do you make of this market here as we kind of get into the back half of January in 2024?
Sure. Thanks for having me. And actually, Independence, Ohio is 10 minutes south of Cleveland. So we're actually in Northern Ohio. So they should really said Cleveland, Ohio. But anyway, S&P, it's kind of surprising after all the bearish talk last year that we would be reaching record highs multiple days in a row. It looks like today might be another one of those days. But it's important to remember what's driving this, right? I mean, everyone's talked about tech driving this Magnificent Seven becoming even more magnificent. But, there may be a reason why. If you look at the underlying trends in the S&P 500, you do have tech leading, but how many stocks and how many sectors or sub-industries are actually hitting those record highs along with the S&P 500? The cyclical parts of the sectors that represent the cyclical parts of the economy, they're not reaching record highs, right? So this is a reflection of some of the changes or the bifurcation that we see in the economy being reflected here. So do I think that tech can continue to run? Well, look, I mean, I think that tech is a part of utilities. The pandemic has taught us that it is a part of infrastructure. We can't live without it. It is part of our daily lives. Some people might say Netflix is a part of their, social infrastructure, as we saw today. I don't think tech is going away, and there's a reason why they're doing so well during the earnings season. So I don't know if it can continue to run at such high valuations. We might be expecting more than perfection from them for the rest of the year, but certainly this isn't some kind of a bubble that's forming.
Well, so I love your idea that tech is safety, like it's utility from that end, because I've wondered that over the last 6 to 8 months. And I do wonder if earnings then matter. I know that's like sacrilege in the middle of earnings season, but then if that's the case, you just buy the dip. And that's why basically the market just doesn't want to go down.
Right. And also, if you think about how far we've come with tech, they're taking up so much of that index. So if there is buying the dip, it's actually also magnified. Now, one risk is if we do hit a soft landing patch where, we're maybe pricing in a soft landing, but maybe there is actually growth happening if the Fed lowers rates, maybe March, probably not, maybe in May. Then we may have recurrence of M&A activity, some more exciting opportunities that can be financed at a cheaper cost. If that happens, then there is a risk that some of the money that went into the buy the dip may be going back into some of the cyclical sectors because they are so cheap.
Speaking of technology, Meta Platforms, formerly known as Facebook, it is up about 1.8% today, all-time high. Now has a market cap once again of $1.01 trillion. So the tech play is still in play. Netflix up 14% as well.
Not even that, but ASML,
yep,
a tech play over in Europe, is also set for a record close. Like it's sort of encompassing many different types of tech.
It is. It's kind of across the board. Hey, Anna, what do you think? What do you think, or what are you guys discounting in terms of Fed cuts in 2024? The market is anywhere from 5 to 6, and a lot of folks are saying, whoa, that's a little too much. How do you guys think about that?
Yeah, I do think that 5 to 6 is probably too much. When it was really pricing in 6, I thought, wait, maybe something might go wrong if we need 6 rate cuts. But here's the thing. The Fed officials have been slowly walking things back, right? So I feel like they're trying to set us up or set the expectations so that it wouldn't be such a surprise if they don't cut rates, if they don't wait until the second half of the year to start cutting rates. So maybe in March, maybe we don't get a rate cut, but maybe we get a repositioning of where the Fed might be. I think the biggest surprise is going to be if the Fed actually says, we're revisiting the 2% target. Maybe it's 2.5. Maybe it's 3.
Well, but that would be okay. If they came out and said we're going to revisit and go to 3, that would be huge.
That would be huge, right? But the thing is, Fed's super core, which is services minus food, energy, and shelter, month over month has been at 0.3%. That is not at 2%. So if the Fed wants to start, and that's been there for a while, so if the Fed wants to start earlier than the second half of the year, they're going to have to come up with some reason because they've been telling us services, super core. We're not seeing any easing there. And actually the PMI today, right, that came out, services is still very strong, and that's a larger part of the economy. And inflation in services tends to be stickier. So we're going to have to see some concessions somewhere to justify an early cut. But certainly the expectations have been heading in that direction.
All right, Anna, thanks so much for joining us. Anna Rathbun, CIO at CBiz Investment Advisory Services, Independence, Ohio. Just right outside. The S&P Global U.S. Manufacturing PMI came out at 50.3. Consensus was 47.6. Last month was 47.9. So a nice expansion vis-a-vis last month in expectation. And I guess most notably to me, it's above 50, which signaling some expansion in manufacturing after we've had so many months of below 50 or contraction.
And it also is interesting when you compare it with Europe, for example. Some parts of Europe was okay, but France and Germany stink. I mean, they're bad numbers, and the order books don't look very good. The UK was better than expected, but it does make you think, okay, have we finally troughed? That seems like a yes. Then do you reaccelerate? And then at what point is it reacceleration not good? Or what point is it still Goldilocks?
Yep, absolutely. And on the services side, which is obviously much bigger here for the U.S. economy, roughly 70% of our economy, global services PMI 52.9. The consensus was 51.5, so much better than consensus, and better than last month, 51.4. So you put it all together, the composite was also positive at 52.3. So again, some good economic data that may give the Fed a sense that, hey, we don't have to rush into this rate cut thing. Maybe we can be a little bit more cautious here. But again, it seems some pretty solid economic data out there. So we'll keep on top of it. This is Bloomberg.
headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Well, this is an exclusive club. Microsoft, for a time there, was up over 1.2%, so that puts it in the $3 billion market cap club. Apple's first break of that threshold was back in June. Investors, right now, they're excited over the growth potential of artificial intelligence for Microsoft. I'll pull back some of those gains right now, up just 1%, 402.93 for Microsoft shares. Traders also parsing S&P Global's U.S. Purchasing Managers Index numbers. They came in better than expected, but with earnings due later in the day from Tesla and IBM, the spotlight still remains in the tech sector. In the driver's seat, Netflix shares soaring after subscriber numbers surpassed expectations, up 13%. And that's the leader in the S&P 500. We have 5 of the 11 major industry groups higher communication services in the lead, and that's where you do find Netflix. S&P 500, 23 points higher. That's up 0.5%. 48.88 on the index. The Dow Jones Industrial Average up 33 points. The NASDAQ 100 up 172 points. That is a 1% gain, and we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so you can head over to youtube.com, search Bloomberg Radio, and that's where you will find us. Boy, I'm looking at Netflix, Alex. Really good quarter in terms of subscribers last night. They're also talking up a big advertising game over the next couple of years. Stock's up 13% at a 52-week high here. It's not at its all-time high, but it's very close. Over the last, I guess, 12 months, it's up 53%. So nice move for the folks at Netflix. Let's check in with somebody who knows this digital advertising, digital media business really, really well. Friend of the show, Mark Douglas. He's the founder and CEO of Mountain. He's zooming in from Miami. I mean, nobody zooms in from like Cleveland in January. They zoom in from Miami.
Yeah, but
so
we literally just had someone from Cleveland.
We literally just had somebody from Cleveland. But these media types. Mark, thanks so much for joining us here. Boy, let's just start with Netflix. A couple things. One, love to get your thoughts about kind of what the results from last night. And then two, love to get your thoughts on getting into wrestling.
Well, let's start with the wrestling. I think that's the most interesting part of it. You know, what the thing about Netflix is, with every other streaming network, you have to have a show you want to watch to go there. With Netflix, you just go because it's Netflix, and then they make the shows popular just because they have this massive audience. And they essentially did that for Formula One. And obviously, Formula One was already a big popular sport, but they made it, really expand the audience and increase the value of Formula One. I think they're going to do the exact same thing for WWE. Like, what was the likelihood I was going to watch a WWE event, yesterday? Very small. Likelihood now, very large.
I have to say, Mark,
it's just sitting there.
I agree with you. Like, I don't necessarily want to watch WWE, but like if they did a documentary of it, 100%, I'd be in on that. Are you worried about content spend? Like, is all of that just going to cost too much for what Netflix is promising the street?
Well, I mean, that used to be a huge problem with Netflix, meaning, on Wall Street, people are like, this company will never make money. And then they focused on profitability and they proved them wrong. And so I think they have that pretty much under control. And then obviously the ad business is just pure profit. Like every dollar revenue they bring in there, net of paying their sales reps commission is just more profit for Netflix. So I think they have that formula very tight, and it's reflected in how the stock market has responded, the value of the company right now.
So, Mark, let's just step back a little bit, because one of the growth drivers for Netflix, in addition to wrestling, I guess, is advertising. Now, this is a business that Netflix has said repeatedly and pointedly that they're not going to get into the advertising business. Well, now they're into the advertising business. And this is your ballywick. This is where you guys operate at Mountain. How do you think they're going to do here? And then what's that mean for the industry?
I think they'll do well in the long term, but I think in the short term, they're still struggling a bit there. And the reason why is they're coming into the television advertising market with a very traditional kind of revenue model, like upfronts and let's sell only to the 1,000 largest advertisers. Meanwhile, you have companies that are treating advertising like a digital advertising market. And that's my own company, Mountain. That's Amazon in particular. And you see Amazon's ad business for TV, they had the confidence that next week they're just flipping their entire customer base over to an ad-supported model. That's because they have tremendous confidence on the ability to monetize it. And the reason for that is they have all of these digital ad buyers on their search business on the Amazon.com website. So I think Netflix, to really grow their ad business, they have to stop operating in the past on the business, using an old kind of traditional media business model. They have to enter the future. That's what Amazon's doing. That's what Mountain has led the way on. And if they do that, they're going to be very successful. As a matter of fact, I think if they do that, the company can double in size. I think Netflix is almost a startup when you look at, in terms of like they just IPO'd, when you look at the potential on the ad business if they do it right.
So walk me through the amount of, okay, so if I'm going to advertise on CBS and I'm going to advertise on Netflix, how much am I paying for each? Like, how is that calculus going to change? And also, would I put ads on both?
Yeah, so as a traditional, we'll call it brand media buyer, you'll just go where the audience that you're trying to reach is, and in traditional media, it's age, and it's very traditionally targeted, and you're happy to do both. The problem that you're kind of alluding to is the brand advertising market is not growing. It grows 0.5% a year. So if you enter that segment of the market, you are in a market share war from day one, and you're seeing that in Netflix growth rate on advertising. It's growing relatively slow. But if you go over the digital market where Google and Meta and Amazon Mountain operate, it's like millions of e-commerce companies who are eager to be on Netflix, who are eager to be on every TV network, and there's a lot more growth there. So Amazon's doing it right. I think my general thing is Netflix will have a good year on advertising. Amazon will have a great year, and I think eventually Netflix will see where the real growth is and pivot over to there. So that's how it works.
Mark, I mean, if anybody who's looked at broadcast or cable television over the last several years in terms of the advertising, it's pretty much all healthcare. It's basically letting you know of all the conditions you're probably suffering from or could be suffering from, and here's the little acronym we're going to put to it so you can remember the name. You can go ask your doctor for this or that drug or procedure. Yeah, I mean, there's I don't see General Motors, I don't see Coca-Cola anymore. I don't, all that kind of stuff. What is the future of advertising for broadcast and cable television? Is there one?
That's what we've been talking about. Now compare that to looking at ads on Meta, on Instagram. Yep. It's all e-commerce. It's all products you may be interested in and, disruptive companies and things like that. So the TV industry is in a transition. NBC made an interesting announcement at CES. CES is at the start of the year in Vegas. It's a big part of the show is advertising, is all these big advertising companies. And they announced that 60% of the ads that run on NBC, linear, cable, and streaming, they expect to be targeted against people's interests and not just their age. And that's a big, big difference because now that starts to enable e-commerce companies and other companies to treat television like they're treating Instagram. And so that's the transition from traditional media to digital media for television, and that is happening. And going back to Netflix kind of sees easy money in the old way, but I think the long term, they have to be part of that. And the answer to your question is all of those TV networks are going to adapt. They're going to go where all the emerging companies are with the emerging ad dollars.
So anecdotally, we cut the cord when my daughter was really little, right? But we're watching Hulu, and we have ads on Hulu, and she literally is like, "What is this? Like, why am I watching?" And she's like, "What's with all the car commercials?" She's like, "Who's buying all these cars? Like, what do I care about this?" Like, she literally blew her little brain about what actually was happening. I thought that was quite funny, but I think it's a deeper point. to what you're saying on like how to reach younger people who have like no concept of traditional television and what advertising actually is.
Yeah, I mean, it's the death of another way to state it is we're going to watch the death of broadcasting and broadcast ads and see the growth of matched ads, so to say, ads that are really tuned to your household and to your daughter's interests and your interests and things like that. And all the advertisers want the latter, and they're slowly abandoning former. They're moving away from the broadcasting and moving more in the digitally targeted television advertising.
All right, Mark, always good to touch base with you. Mark Douglas, the founder and CEO of Mountain, down there in Miami. It looks quite nice here, but I mean, I need the 4 seasons. I mean, I can't go.
You do, yeah.
I can't be just
summering
down in Miami and wintering
he's Paul
on the,
Sweeney.
Whatever, however they do that down there. But good for him. That's what the media folks do.
But back to my daughter and commercials.
Yep.
She literally doesn't understand why every commercial is cars. She's
Right.
like, who buys all these cars? What are they doing with these cars? Why do I need these cars?
That makes her the smartest person in advertising right now.
Because all it is, it's like it's like Geico, and then it's car after car after car, and she's like, "This is not me, people. This is not what I need."
Exactly. And those ads used to be on CBS, ABC,
That's right.
CNN, blah, 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 blah. And it used to make up 60% of TV advertising back in the day, particularly on Thursday nights. That's the prime audience time because people are going to go shopping starting Friday and over the weekend. That's why it was must-see TV for NBC for all those years. Right now, let's head down to Washington, D.C. World and national news with Amy Morris.
All right, thank you, Paul. Former President Trump is taking a victory lap after winning in the New Hampshire presidential primary, but he didn't think his opponent, Nikki Haley, gave much of a concession speech.
And she was up, and I said, wow, she's doing like a speech like she won. She didn't win, she lost.
Haley says she plans to stay in the race for the White House.
New Hampshire is first in the nation. It is not the last in the nation.
Still, the back-to-back wins put Trump on track to deliver a knockout blow to Haley next month in her home state of South Carolina. In the Democratic race, President Biden was not on the ballot but won New Hampshire's primary as a write-in candidate. Boeing CEO will be on Capitol Hill today, the first of a series of at least 2 meetings with senators as part of the company's damage control mission. Dave Calhoun is meeting with senators today and tomorrow as the plane maker works to reassure airline customers and the FAA that its jets are safe. A Russian military plane carrying at least 74 people crashed north of the Ukrainian border. Russia's Ministry of Defense says the aircraft was carrying 65 Ukrainian prisoners of war. They were part of an exchange when it went down. The governor there says no one survived. The U.S. has opened another digital hub for the people of Nigeria to help close the digital divide between Africa and the Western world. And Secretary of State Antony Blinken was there for the ribbon-cutting ceremony.
I'm grateful to you for the partnership that we have between our countries, but also for your extraordinary leadership and vision in making Nigeria a tech powerhouse.
The U.S. touts the American Cornerlecki as the future of providing easy access to everything from internet access to digital resources on U.S. culture, English language learning opportunities, and professional development and skills programs. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Earnings from tech companies driving the major stock averages higher today. We did also get some economic data. Business activity in January expanding at the fastest pace in about 7 months. Netflix shares soaring. Subscriber numbers surpassed expectations. We got those results after the close of regular trading yesterday. And with the bang-up results from Netflix, Chris Morengi at Gamco says, you know what? Their competitors need to act fast.
We're going to need consolidation. Netflix, the quarter that they put up, shows that scale matters. We used to talk about the insurgents versus the incumbents. Netflix is now an incumbent. They're clearly the global leader in streaming, and they are able to flex that muscle and adding subscribers and doing the deal that they did yesterday with Raw. And the rest of the industry, the former incumbents, are going to need to follow.
And Netflix shares 13% higher. Earnings due later in the day from Tesla and IBM, so the spotlight firmly remaining on technology. And it's worth saying Microsoft has surpassed $3 trillion in market capitalization. Those shares right now, they are up 1.24%. A lot of this has to do with the strength and the confidence in artificial intelligence from Microsoft. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
John Tucker, thank you so much for that. We appreciate it. Alex Steele and Paul Sweeney, we're with you here in the Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Looking at Tesla, they report after the close tonight. Trailing 12 months, stocks up 46%, market cap $670 billion. The real issue for me, and it's not just a Tesla issue, it's a EV issue, and thankfully Matt Miller's not here because he would take us completely off the rails, is what's the demand for electric vehicles really at the end of the day? I don't have a good idea, and I don't think a lot of investors do as well, but somebody who's got an opinion on this because he does this for a living is Steve Mann. He covers automobiles, industrials for Bloomberg Intelligence. He's located on our Princeton, New Jersey campus, which, by the way, is pretty cool, and it's got EV charging stations.
Does it
there.
really?
Yeah, we were like the first. Before there was even a Tesla on the road, we had EV charging.
Do they charge you for that?
No.
It's free.
It's free.
Well, why don't they give me free gasoline?
Well, they give you. That's what I keep telling you. You can expense this, man.
Incentives.
Expense this. And they also have this huge solar farm out there behind
That's really
that
cool.
fires up the whole building. So we're all doing that green thing down in Princeton. Steve, thanks for joining us, my friend. After the close today, what's important for Elon to get across to the marketplace?
Hey, Paul. Hi, Alex. Thanks for having me on. I think the investors will be primarily focus on, their outlook. They've just cut prices again in China. What does that mean for the marketplace? Like at BI, we think, growth is definitely going to slow down, particularly in the U.S., up 9% versus, 25, 30% last year. So I think that's where it's going to heading. How is the market doing? Do they need any more price cuts? And how that's going to impact the margins?
What do you think is going to happen?
Well, I think it's going to be a challenging year for Tesla because, they've cut a lot of prices, 25% through 2023. Are they going to cut more? And then on top of that, they're ramping up the Cybertruck. The Cybertruck is not easy to build, especially using stainless steel. And that could pose as a headwind for margins as well. So we actually think margins will stay flat. Okay, it's probably not as bad as some people think in the marketplace. I do think Tesla has proven on execution. They're the only auto company that's gone almost 2 million units in the last 50 years. So they faced a lot of challenges before. I think they will get over the Cybertruck. It's just how soon can they get over that?
Hey, Steve, a lot of folks are skeptical, and you can count me as one of them on the whole EV revolution. Some people say people don't want to buy electric cars. They want to buy Teslas. What do you think about that?
Well, Tesla has a unique offering. Like, if you look at the infotainment, the connectivity of a Tesla vehicle, that's they're way ahead of the competition. I think if you're asking some of the tech-savvy consumer, that would be their first choice. Secondly, it's charging. I think they do have the most extensive charging network in the U.S., and you can see why GM and Ford and other legacy automakers are actually partnering with Tesla. So in terms of convenience, they're ahead of the game, and hopefully Tesla can maintain that. And Tesla itself has really done a good job in cutting costs. I think they're also ahead of the game in the manufacturing side. They're able to produce Tesla much cheaper. This gives them a lot of room and leeway to cut prices like they have and still maintain a level of profitability. So, charging station is important, connectivity is important, and I think Tesla can compete on the affordability challenges that's facing the industry.
Steve, I've been hearing a lot more over the last few months, really, how hybrid is actually going to be more important, and that we will get to EVs for sure, but that we're underestimating the need for hybrid vehicles as we deal with everything you just said. Range anxiety, charging, affordability, and all that kind of stuff. How much of a risk do you think that this could be for Tesla?
I mean, huge risk. Yeah, I was actually considering buying a hybrid. I did consider buying an EV, but the plug-in hybrid makes much more sense as we transition into battery electric.
Right.
The issue right now in the marketplace is that the supply chain for batteries that are used in battery electric is not in the U.S. They're primarily in China. U.S. automakers, anybody producing EVs here, have to outsource, and that's an added cost of shipping those batteries over here. So I think between now and say 2025, 2026, there's a lot of new battery plants coming online in the U.S. And so once we onshore a lot of the batteries that goes into those vehicles, I think we'll start to see prices becoming more affordable. And I think that's going to be an important component in the consumer's decision in buying or not buying a battery electric. But you're right.
Well,
between now and then,
yeah,
plug-in hybrid is probably a better choice.
So Paul is my indicator, okay, for things that the world is moving towards, but that a lot of people aren't moving on board with. He's my guy. So ESG, Paul, not a thing. So hybrid. I know you just bought a new car and it was an ICE, but like the next car you buy, would you do a hybrid?
Probably not. Probably not. I put it this way. I'm an economic animal, and I certainly would not pay a premium for that. If costs were all else equal, maybe I could do my green thing.
This would be huge. This is a huge moment.
This would be huge for the industry. They're quaking in Detroit. So, Steve, real quick here, the F-150 Lightning, I drove it. Matt Miller got me a truck for a week. It was an awesome vehicle. I was surprised when I saw Ford cut production there. What's going on there?
It's all about profitability. If you look at Tesla, I don't think Tesla, they care about the investor, but, they're looking a little bit long-term. But, Ford is probably a little bit more sensitive to the short-term investor. And the price cuts that Tesla and other automakers have initiated really put a dent on profits for Ford. If you look at third quarter, their operating margins on electric vehicles was a negative 75%.
Oof.
That's down from like a negative 40% earlier in 2023. So they've taken a huge hit on producing and selling EVs. So I think there's a balancing act between, in 2024. I don't think they can get out of EVs totally, because if they do, they'll probably fall. They could fall behind. 2025, 2026. So they're going to have to kind of manage that, balance that, and minimize the losses.
I mean, I kind of feel like the auto industry is like the media industry undergoing a fundamental transition, and as such, I don't know how you invest in it. If I were an investor, I'd be just staying away because that's a fundamental change in their business. Steve Mann, automobiles and industrials analyst for Bloomberg Intelligence, joining us here. We got Tesla after the close. This is Bloomberg.